briefly give us the keynote address. And actually, he was very, very kind to us to give two talks, actually, two plenary talks. The first talk is of the LIBOR transition. This is one of the key topics currently, because in all jurisdictions, they have taken a step of moving away from LIBOR related. Professor Eric Sodom is one of the respected researchers in quantitative finance from Australia, and also has been collaborating with other researchers, especially from here in South Africa. And he's also our scientific board member for the NITheCS. And we're very honored to have you, Prof. And over to you.
Thank you, Monsieur. Do we have a clicker or thing for advancing the slides, or do I just do it on the? I do it on the computer. Okay, great. Okay, thank you for coming. So, and also I want to thank NITheCS for inviting me here for this workshop. It's already been a very, very interesting set of talks. So I'll hope to be able to keep things at that high level that's already been established. And yes, so my talk is about the market information that we're losing in those jurisdictions that have decided to move away from LIBOR, basically abolish LIBOR in their currency and replace it by these new alternative interest rate benchmarks. And so that's where the title comes from, Lost in the LIBOR Transition. It's joint work with three people, Alex Backwell, Andrea Macrina, and David Scoffman. Actually, this list of affiliations, as you may have taken out of Matthias's comments, they're actually all my affiliations. So I'm based in mainly at the University of Technology, Sydney in Australia. However, I also hold honorary positions at UCT and at UJ. And recently been asked to join the scientific advisory board of NITheCS, though that's more of an independent outside role, right? So I won't be adding that to my list when I give talks. Thank you. Right, so where are we here? Back. Okay. So yes, so maybe it's good just to get right into it. The things changed, of course, in interest rate modeling, which for people like me was a very good thing, because for a while, it's just before the global financial crisis, it almost seemed like everything in interest rate modeling had already been done. And then the global financial crisis hit 2007, 2008. And that changed the perception of certain risks in the market. So it also very strongly impacted the interbank lending market. So during the financial crisis, so when Lehman Brothers collapsed, liquidity in the interbank lending totally dried up. The central bank stepped in and flooded the market with liquidity. And as a consequence of that, actually, even after the crisis had more or less played out, so when the markets were recovering, interbank lending never got back to those levels that it used to be, right? So the actual market backing things like LIBOR, which is an interbank lending rate, that was really reduced. And also, I mean, that fundamentally is a problem, right? Actually, perhaps that drying up of liquidity was what actually made it possible in the first place that we had these LIBOR manipulation scandals, right? So because if there's a lot of liquidity in the market, it's much harder to manipulate. So it impacted the interbank lending rates. It also impacted the dynamics of the overnight rates, which became much more driven by central bank policy. All these things then led the regulators in a lot of jurisdictions, so foremost the UK and the US, to basically say we want to get rid of LIBOR and we want to move to these alternative benchmarks. Now, that hasn't happened in all jurisdictions. For for example, in the Eurozone, we have still both, right? So Euribor, so there's new benchmarks based on overnight rates, but there's also still Euribor. Same in Australia. The Australian version of LIBOR is called BBSW, Bank Bill Swap Rate, and that's also still around. And actually, there is not really much of an overnight benchmark in Australia yet. So one of the consequences, though, of the global financial crisis was that many of the textbook arbitrage relationships between the spot forward and swap markets, they no longer held even an approximation. And so we're going to look at that actually in a bit more detail a little bit further on. So in particular, swaps and forwards, they are quoted at substantially higher basis spreads than before the global financial crisis. So that was that's one key consequence. And the other key consequence is that the LIBOR type benchmarks, as I've already said, they're being replaced by these alternative benchmarks based on overnight rates. And those two things together actually are what leads us to conclude that there's a substantial loss of market information. Right? So the reason why the LIBOR type benchmarks, I'm going to actually get into that and explain why that's so, but the reason why the LIBOR type benchmarks have market information that is not in the new benchmarks is actually strongly related to these basis spreads. Okay. So this work is directly based on two papers. So one was the work that we published back in 2023, and the other one with the same title as this talk appeared in Quantitative Finance earlier this year. So it's still quite fresh, so fresh enough to talk about in a workshop. So looking at these basis spreads, right? This is also called a frequency basis because it's a basis that is related to the payment frequency on a swap, right? So we're quarterly versus monthly or whatever. So when you have a basis swap, also known as a tenor swap, that swap exchanges floating for floating. And the difference between the two legs is just the frequency. And if you go to some of the old textbooks, right, and actually just in a way that they're still around, like Powell's book, right, and then you read up on this stuff and look at it in just a totally classical sort of way. Well, floating for floating interest rate swap should be totally uninteresting because the two legs are floating, and that means automatically their present value is the same, right? So there should be no spread. Any spread added to one of the legs of the swap would represent an arbitrage opportunity. And before the global financial crisis, that wasn't strictly true, but within transaction costs, basically, there was no arbitrage opportunity. And then it blew out, and it never came back. Right? I mean, the basis spreads are no longer as big as they were 2007, 2008, but they're also no longer as small as they were before that, right? So they definitely, if you actually believe this was an arbitrage opportunity, then yes, it would go beyond what would be explained by transaction costs. Now, the other consequence of this is, of course, then now if we have interest rates that depend on the payment frequency, that means that we no longer have one discount curve. Right? So which curve, which interest rate curve we're looking at depends now on the actual payment frequency. That's the so-called multi-curve world of interest rates that we live in now. And and that means that each of these curves, they also can display quite distinct dynamics, right? So the spreads between these curves, they're not constant over time, right? They do vary in a way that looks quite stochastic. So these differences are usually explained by varying levels of risk premium, right? Driving these different tenors, and generally attributed to default risk and liquidity risk. And we're going to go down that route as well. but in a way that I think is actually provides more explanatory power than a lot of the studies that came before that, because a lot of the studies that came before that that tried to link these things, these spreads, to default risk and credit risk. A lot of them were basically regression type explanatory studies, which didn't actually look at fundamental relationships, right? So basically, and what started us thinking about this was, well, okay, classical theory tells us that these basis spreads should trigger arbitrage opportunities if we still believe in the classical theory. So there must be something blocking the arbitrage channel for these things to persist in the market, right? And that's how we got to our model. So just to give an example of what's been done in the literature. So prior to our work, the literature is mainly divided into two parts, right? So one is sort of a pragmatic approach, very industry quant type approach, where people say, well, these spreads exist, okay, we just accept that, and then we just say that in our models we're going to have them, right? Which is so we're not even trying to explain where they're coming from. We're just going to make sure our models have them. So that's basically a whole set of literature. Then also that approach was then also reflected in a whole bunch of academic papers, some of which are listed there on the slide. Now, the alternative way of looking at this, of course, was the more fundamental approach to try to actually explain this. So either econometrically or with a bit more modeling. So there were papers trying to explain this just via default risk, which is not that easy, right? Because LIBOR, so if you're taking a floating for floating swap on LIBOR, I mean, the credit risk is the same, right? For these rates, because they're both based on a AA bank counterparty, right? But then there was another paper, actually a few more than that, which just looked at liquidity risk. Capet and Douadi took more of an equilibrium modeling approach. And actually, the one that comes closest to what we're doing is a paper by Filipowicz and Trolle, which is which was something, the title of that paper, something along the lines of the term structure of interbank risk. Right? But and they also then try to divide things up into credit risk, so default risk, and liquidity risk, but it's really a primarily econometric approach, right? So again, it doesn't look at these arbitrage mechanisms in the basis swap, which is perhaps it's not really a criticism of their work, because their work is very early on, just right after these things have started to become significant in the market. So taking the approach of actually looking at what blocks the arbitrage channel, a paper that Martino Garcelli and I had together with NITheCS, that actually was the paper that really first did the modeling and tried to link these basis spreads to risks blocking the arbitrage channel on to take advantage of basis spreads. So that was then we did a follow-up paper. Well, I did a follow-up paper with Alex Backwell and etc. So the first paper that I cited early on, and the reason why we had to change some modeling in that paper is because this approach doesn't really lend itself to econometric estimation, right? That's so actually the main contribution of that final paper there on the list is moving from the fundamental idea that's in Alfeos et al. To the to something that can be econometrically implemented on data, rather than That's a cross-sectional calibration approach, right? Which would be the standard industry quant type approach. Okay, so the main idea is to look at what's blocking the arbitrage channel. And so we have to look at the arbitrage strategy that a naive quant might set up who thinks that these basis spreads actually represent an arbitrage opportunity. So let's say we have a 3 versus 6 month basis swap. So a 3-month frequency against a 6-month frequency, and there's a spread of 50 basis points. And the spread is always added to the shorter tenor. Okay, and there's a reason for that, as we'll see in a moment. If it were the other way around, it would actually be an arbitrage opportunity. So if we want to take advantage of that, since the spread is being added to the shorter tenor, what do we have to do? We have to lend. We have to lend at the longer tenor, right? And borrow at the shorter tenor. Right? So our strategy is we're going to borrow at the 3-month rate. Right? So just everything normalized with $1, which means that after 3 months, we have to pay interest. And then at the final date, so just to keep things simple, I'm only considering 2 dates, so a total of 6 months, right? We have to repay the borrowing and that second interest payment. And we lend at the longer tenor, so we lend for 6 months. So there's nothing happening here on the lending leg. While then, of course, we get our lending back, hopefully, and the interest payment. And then we enter into a basis swap to offset these cash flows, right? And because we've got this spread added to the shorter tenor, we can keep that spread, right? Because the only thing we need to cancel here is the LIBOR, right? That cancels against that. And here, this is the leg, because we're lending here, we're going to be paying this leg here, so that cancels that. And the repayment of the borrowing, of course, and lending, they cancel up here. And that gives us then a gain of 12.5 basis points each time. So what's the problem with this? The problem is that we have to roll over our borrowing. And so the assumption is that we're going to be able to, in 3 months, we're going to be able to roll over our borrowing at LIBOR. And that's where the problem comes in, right? And which the market very well understood during the global financial crisis. The 2 things that can mess this up. One is we could get downgraded. That's the credit part, right? If we get downgraded, suddenly we have to pay more to refinance. Or liquidity could dry up in the market, like it did after the Lehman collapse, where, okay, LIBOR was quoted, but nobody's willing to lend, was actually willing to lend you at LIBOR, right? So that's the liquidity part. And so the risk that blocks the arbitrage channel is the risk of not being able to refinance the short-term borrowing. So not being able to roll over the lending. So that's why we call it rollover risk. So if you Google rollover risk, you'll find something about off-road vehicles. Right, so to recap, the basis spreads, they must be due to a new perception by the market, which then blocks these arbitrage channels. So we explicitly model that risk, right? With the 2 components, downgrade risk and funding liquidity risk. And if one does this, we actually have a less ad hoc model than all this pragmatic multi-curve modeling that was going on, where it still is going on in a lot of places. It basically reduces the dimensionality of the model down to modeling these 2 sources of risk. while with a pragmatic approach, basically you have a new source of risk for every frequency, right? And if there's a new frequency that you want to actually price, that's not traded in the market, you don't know how you're going to do it, right? While with a model like this, once you've modeled the downgrade risk and the funding liquidity risk, you do. And so in particular, it would allow the relative pricing of bespoke tenors in a consistently calibrated model. And it doesn't require the introduction of any new stochastic factor for each new tenor. However, of course, this is still a reduced form approach in the sense that we don't say where the risk of downgrade or the risk of liquidity drying up, where that comes from, right? So there's no fundamental equilibrium model or something behind that. But in a sense, this means that this approach is closer in spirit to these types of reduced form models that we like to do in credit, right? Where we model default risk to drive the credit spreads, but we don't model where the default risk comes from. But it's a lot less reduced form than this pragmatic approach, right? So basically, the pragmatic approach was reduced squared, and we've removed one of those reductions by actually at least explaining the basis spreads via more fundamental risks. Now, doing that also allows us to make explicit the market information which may, and in some jurisdictions has, been lost due to the transition away from the LIBOR benchmarks to the overnight rate benchmarks. This is because LIBOR is a term rate benchmark, right? So it's and actually LIBOR is not just one index; it's a whole family of indices, right? And for different lending periods, right? 3-month LIBOR, 6-month LIBOR, and so on. And on the other hand, the rate that's underlying overnight index swaps, that's an overnight rate. And typically it's an unsecured rate, interbank, similar to LIBOR and credit risk. But of course, it's different in interest rate risk because it's for a different lending period. However, that interest rate risk can be eliminated just by entering into an overnight index swap. But nevertheless, what we see in the market that there's a spread between OIS and LIBOR, which is again the same sort of phenomenon that we see in the basis. Just where here we're overnight is just the most extreme, the shortest tenor, right? That's it. So this spread can be interpreted as a premium that's paid in the market for risk. Right? It's the premium that you pay in the market for avoiding rollover risk. Or more classically, you could actually consider it as the term premium as such, right? As a real term premium. So when we then look at LIBOR replacements, in US dollars, the secured overnight funding rate has replaced LIBOR, which means that it actually differs from LIBOR with respect to credit risk because it's secured, right? It's effectively a risk-free rate. However, one can deal with that in terms of modeling what that should be if it were just so if one looks at the difference between SOFR and LIBOR, then one can model what that spread should be just based on information, let's say, from credit default swaps. But turns out, no, it doesn't. That doesn't explain it fully, only partially. And this is because SOFR doesn't have rollover; it neglects the rollover risk, and in particular, these term rates in inverted commas that have been suggested, like SOFR compounded and things like that, they still neglect the rollover risk, and our modeling shows that this is not negligible. So any term structure that you would base on SOFR and SOFR compounded and futures on SOFR, any such term structure is more like a term structure based on OIS rather than a term structure based on LIBOR. That's what, for example, you can see that. So we've got our 3-month LIBOR in black, the 3-month compounded SOFR in red. One thing is that there's a lag because the 3-month compounded SOFR is backward looking. But then beyond that lag, there's also a spread. And if one just plots the spread, you can clearly see that it's not a constant, right? So it carries its own information. Right, so then going into the modeling, so we just standard setup, right, sort of probability space, etc. And we call RT the risk-free rate. Now, in abstraction from overnight, we're just using this as the instantaneous risk-free rate, close enough to overnight, right? It just makes the mathematics a lot cleaner. And then in terms of that risk-free rate, we can define the savings account, and that will be the numeraire that's associated with our starting risk-neutral measures. And then furthermore, we have the overnight rate, right? So if we have the OIS type overnight rate, then that is subject to credit risk. Basically, and in our model, it's subject to market-wide systematic credit risk, which we give here by the CT. And examples of such rates that would be this RON would be things like Fed funds rate, and or things like Eonia or Sonia. So the contrast to that is the risk-free rate, which I introduced in the beginning, right? So we can relate that back to the to SOFR in this way. No, sorry, to things like Eonia in this way, or EFFR, it's the Fed funds rate in this way. And an example of such a secured rate would be SOFR in particular, or SARON in Switzerland, and so on. Another rate that we need is the collateral rate, right? Because ever since the work of these guys here, we know that when we have a collateralized derivative transaction, the actual discount rate under the spot risk neutral measure that we should be using is not the risk-free rate, it's the collateral rate, whatever that collateral rate is, right? If the collateral rate is the risk-free rate, well, then things don't change. But if the collateral rate is something else, then we have to use that, right? So that's just a very basic and very fundamental key result. Because nowadays, most of these derivative transactions, like OIS, so overnight index swap, they're all collateralized transactions, which means that we don't have to consider counterparty credit risk. That's a good thing. But we do have to be careful to use the right discount rate. So an example of a collateralized instrument is the overnight index swap, right? Which is written on an overnight benchmark rate. So for example, Fed funds rate. And usually the collateral rate is equal to the overnight rate, which is quite convenient. And then, so if we then want to obtain the fair swap rate, meaning the swap rate that sets the initial value of the overnight index swap to 0, we can just price it in this way, right? Where this HT is the final payoff of an overnight index swap, right? So this is the accrued floating overnight rate in our mathematical abstraction, the instantaneous rate. And this is the fixed payment, right? For the fixed leg of the overnight index swap. Right, so that means we can actually solve that for an implied discount factor, right? From OIS, right? So these OIS discount factors, and because the rate underlying an OIS is a rate that we need to discount collateralized derivative transactions, this is actually a very important discount factor. And one of the problems in the South African market is, of course, that we don't have these overnight index swaps, and we're missing those rates. So actually some of the modeling that we're doing has some implications for that, how one could have extracted information from the market for an overnight index swap curve if one didn't get rid of the actual term rates. But that's more of a could have rather than something that we can actually do based on what the in South Africa, based on the information that's available currently. Right. So that's the overnight index swap discount curve. So that's one curve. And then to actually work in our model, looking at the other curves, right, we need to look at the term rates, like LIBOR. So we need to model those. And so the IMO term rate is just a generic name for a benchmark meant to reflect the cost of borrowing at term. And if it's a LIBOR, like that was based usually on panel member banks supplying quotes, and those are then aggregated by some mechanism into the benchmark. Right. So so there's some map here that takes these rates reported by the different members of the panel and converts it into a benchmark. And we're going to remain agnostic about that mechanism, right? We don't need to model that mechanism in our model. So that's actually a good thing, because it means that by keeping that abstract, we don't have to say whether it's based on quotes, supply, right, the way LIBOR was, or whether it's actually based on actual transactions. For example, BBSW in Australia has a strong transaction-based component, which is maybe why there hasn't been any real effort to get rid of it, because it's much harder to manipulate. People have tried, but it's much harder to manipulate. Right. So to model that, we actually need to model the borrowing rates, right, of these entities. And that's where the rollover risk comes in, right? So we have this benchmark market overnight rate. So if you are in the market average, right, if you're just your AA rated bank, then you can borrow at that rate. However, if once we're looking at a fixed entity, a fixed bank, that bank may end up no longer being in that average, right? They may depart from that, and they may get downgraded, or liquidity might dry up, and none of the banks can borrow at that rate. So we model that by saying that okay, at the current instance, at little t, the current point in time, we are able to borrow at that rate. But then at any date in the future, there may be this spread, right? So these gammas, this is actually not just one function, right? It's one that is specific to each bank. And so it's actually a family of functions. So at time little t, if we say that the entity is in that group of representative entities in the market, that spread is zero. Right? So anyone who's actually representative for the market, they have this gamma of zero. However, all of them have the risk that it won't be zero in the future. That's rollover. So in this notation, I'll just repeat that. The little t denotes the time at which an arbitrary but fixed entity may borrow at the market benchmark rate. But it won't necessarily be able to do that in the future. So this gamma departing from zero at some future time u, that represents a rollover risk event. And this risk will then be reflected in the market representative benchmark rates, because term rates have to be based on, well, risk neutral expectations of future short rates. Right? That's just standard in interest rate term structure modeling. That's still the case here, but it's just that now each entity has this additional risk, and that's what introduces then the premium in the term rate. And we break that down further, right? So we've called the gamma, that's just the rollover risk, wherever it comes from. But I've already explained that there's actually two sources here of potential rollover risk. One is the downgrade risk, so we call that lambda. And the other one is the funding liquidity spread. So if the market dries up, then basically you can't borrow at the benchmark rate, but you may be able to borrow at some higher rate, possibly astronomically higher, but a higher rate, and that's the phi part. Right, so the event that this departs from zero would be rare. Right, usually financial institutions would be able to fund themselves close to the benchmark in normal states of the world, but there's always the risk, right? And that's what we're modeling. Now, one could look at, so that's introduced the model, and now we can just rearrange things just for interpretation purposes. So we could look at, for example, the total funding rate, right? The total funding rate is the benchmark rate plus the funding spread plus the actual credit spread, because the actual credit spread is going to have two parts. Right? It's going to have the systematic credit spread, the one that every bank has to pay for a AA, and the idiosyncratic one, right? So this is going to be zero initially because we're we're representative, but if we get downgraded, then that's non-zero, right? Now it's important to have this big lambda, because the big lambda, of course, is directly related to the intensity of default in a reduced form credit model, which is what we're using. Right. So if we then look at the value of an unsecured rollover risk adjusted borrowing account of an entity that's exposed to funding, liquidity, and credit risk, and we get this relationship, right? So this was the rate that you have to pay as such an entity, right? So here I'm just calculating the present value of borrowing, of the repayment at maturity of such a borrowing at this total funding rate. And what we see here is that the lambdas actually cancel out, right, which is unsurprising, because that's covered by the credit spread. However, the funding liquidity part is not covered by the credit spread. That's still in this, so that still enters into, that changes the present value. If I borrow $1 and then consider now the present value of my repayment in the future, if I take into account the credit spread, the two are equal if there's no funding liquidity risk. But the funding liquidity risk actually makes these two no longer equal to each other. Right, and then we can look at, for example, a defaultable discount bond. Well, so we're looking at a zero coupon bond. That's a repayment of $1 in the future. We're assuming zero recovery here, but only if we don't default, right? So that's why that indicator function, right? Default is beyond the maturity. So we take again the discounted expected value, and then we just get this is just the standard relationship, right? The yield on a defaultable bond with zero recovery is identical to the intensity of default, right? Identical to the risk-free rate plus the intensity of default, just standard result from it. Right. And now let's to now finish this, right? To actually get our term rate LIBOR, we have to consider the following strategy. We borrow 1 unit of currency at time little t and roll that over continuously until time t. And the AT was what gave us the present value of that, right? Alternatively, we could borrow at the term rate, right? If we borrow at the term rate, then the present value of the repayment of $1 at that time is this, right? So we've got, if we're borrowing at a term rate L, which we haven't said what that is yet, right? Then we have to repay 1 plus length of the accrual period times L. But we only do that if we haven't defaulted. And we discount, and then and to value that, we discount that at the risk-free rate. Okay, now based on how I've defined this defaultable discount bond, that's simply just the defaultable discount bond times the 1 plus LIBOR, right? Because this is already known at time little t. Okay, now in equilibrium, this is not an arbitrage argument, right? It's a bit weaker than that. But basically, supply and demand should balance things into that in equilibrium in the market. The entities should be indifferent between one or the other, right? Because if one is cheaper, then more people will be doing that and should drive the price up. You cannot actually construct an arbitrage. But where the equilibrium argument could at least say, well, yes, in the long term, on a long-term average, these two things should be equal. And so setting the two sides from the previous slide equal, right? The one side was just the A, and then solving for LIBOR, we get this relationship. Now, if you're up to speed with all of this credit risk modeling stuff, you immediately see what the difference now is, right? Because it's this A. Because otherwise, it would just so if in a traditional model, this would be just 1 over the defaultable bond. Right, so that gives us then, so that means that we now have an expression for the LIBOR term rates in our model. And if we want to look at the spread between LIBOR and OIS, that has this multiplicative form, right? And that's now been endogenously derived. Filipovic and Troller, who get closest to us in their approach, they have a different relationship, but that's because they didn't go through this sort of argument, right? They make it just ad hoc assumptions. Right. So one thing to note is that the spread will always be this multiplicative spread will always be greater than 1, right? Because the Q will be less than the OIS discount factor and the A will be greater than or equal to 1, both by construction. And it's this multiplicative spread that's the premium that the borrower pays to avoid refinancing this. And just for consistency, we can look at what happens if we let the term shorten back down to 0, and we get exactly the overnight rate. So good, right? If we had got anything else there, that would have been a worry. But that also means that the rollover risk premium is embedded only in the term rates, not in the overnight rate. Right, so then we can take the model to the data. So we're looking at Ionia versus Euribor, right? And so to fit this whole model, right? You've seen there's a lot of moving pieces, right? There's a lot of stuff that we need information on. So we need the OIS, we need the actual swap rates for Euribor, or as many different frequencies, tenors that we can get. So we would have 3-month, and in this case, we're looking at 3-month and 6-month. Right? All right, so doing that, we can see that the model certainly can fit the market pretty well. I mean, I haven't told you exactly what stochastic assumptions we've made here. That's all in the paper, right? So what the actual diffusion process looks like. But this is just standard affine term structure modeling stuff. So there's nothing special going on there. But if we put that all together in our model and then run an unscented Kalman filter to estimate the model, we get a fit that's very, very close to the market, right? So the crosses are on top of pretty much on top of the lines, right? And if we then look at, again, so if we then actually look at the spreads, right? So we're actually magnifying things here by taking differences, right? So we're basically zooming in on the differences between the market and the model relative to the previous plots. You see that even if we're looking at Euribor OIS spreads, we're still getting pretty close, right? Here for the 1 year spread for 3-month Euribor with OIS, it doesn't work quite as well, but as an econometric fit, this is still very good. So once we've fitted the model, we can actually look at the credit versus liquidity component, right? Remember, the credit component in the model is actually driven by credit default swaps, right? So we're actually calibrating that, and that means that the basis swaps primarily will give us information about the funding liquidity risk, if any. But if we then go and take the model and turn off funding liquidity risk, let's set that artificially to 0 after the model has been calibrated, then we can see how much of the spread is actually determined by this funding liquidity risk. And we can see it's substantial, right? Because if we turn off funding liquidity risk, so we're only left with downgrade risk, the model tells us that the spread should be much, much lower. And so clearly, a large part of this is traumatic experience that the market had during the global financial crisis, the knowledge that there is always the possibility that liquidity might dry up, and that's now being priced in. That's directly in these spreads. Right, and then another exercise that one can do with this model, of course, is then to look at what would the ideal benchmarks actually look like if we had them, at least according to the model. Because the problem, so the problem with these new benchmarks is that they're based only on overnight rates, right? So and that's only one term, and it's only the shortest one. So there's no information left in the market index about this rollover risk. We were able to extract it from the old benchmarks, but with the new one, no. So ideally, if you want, because the new benchmarks, they're typically based on repo transactions. If the regulators were satisfied that there are enough term repo transactions, right? So not just overnight repo transactions, but let's say 3-month repo transactions, then we could have a 3-month repo rate as another benchmark, right? Which would be great because that would incorporate the rollover risk. But we don't have that. But however, our model can tell us what those rates should be, right? So here we have, the reason why you might want to plot these is because here you're getting the term rates, term premium for rates that are not subject to credit risk. So this is just the funding liquidity risk only impacting the term structure. Right, so what we've seen is that, and actually all this modeling was with constant parameters, right? No time. Then if you wanted to do a cross-sectional calibration, right, for 1 day, where you're just fitting the parameters to the market, you can get a perfect fit, no problem, right? This was an econometric model with constant parameters, but that still did a pretty good job in fitting the market. All these different tenors, right? This huge amount of data, all in one model, in a single consistent model. And empirically, the credit risk typically contributes only about 30% to the Euribor OIS spread. If we then calculate the theoretical repo-based benchmarks, you would still have multiple term structures. But these things aren't there, right? SOFR compounded is still based on the overnight rate. It's not really a term rate. So then, what is lost with the demise of LIBOR? And there was a very nice article, and this is a non-technical risk magazine article, just about the, just interviewing people in the market. Unsurprisingly, I mean, these guys hadn't read our paper, right? So they were just speaking out of their market experience. But they're basically saying the same thing, right? The demise of LIBOR makes it actually very difficult to hedge bank funding risk. So you've got your fundamental interest rate risk that you can swap out with SOFR, but the actual systemic credit and liquidity spreads, you have no way to hedge it. Exactly, right? So the FRA OIS spreads, right? So with the FRA, they're based on LIBOR, that would actually measure stress in the banking system, they no longer exist. And the fact that this no longer exists could be contributing to market volatility. So that, for example, in March 2023, they were seeing quite a bit of, because now suddenly people don't know what's going on. We then went on and and tried to pursue that question a bit further. So if the rollover risk is indeed the driver of basis swap spreads, then one should be able to use the model to interpolate, and perhaps, if we're getting really ambitious, even extrapolate. And so we should, let's say we take our market information, we artificially drop one of the tenors, so one of the frequencies, then create that artificially with our model. It should match what the market is telling us reasonably closely. And if we're really lucky, we can even create artificially an OIS, right? But that's extrapolation, because OIS is the most frequent, right? And that's at the extreme end. Right. So here we've done such an extrapolation, right? In preparation for trying to get OIS. We just said, okay, we'll use the 3-month, 6-month, and 12-month tenors and try to get the 1-month tenor. So that gives us the blue curve, and you can see that those are the errors relative to the true 1 month. And it's not that great, because my interest rate's 5 basis points. So the scale there is in basis points, is already problematic. But if you actually didn't have, so you of course you'd still use the market information, you wouldn't get rid of it. But if you don't have market information, then getting at least within 5 or 10 basis points of what it should be is better than nothing, right? The other thing, so the blue one is actual extrapolation, and the red one is interpolation, because there we're using OIS as well, right? So we're using the overnight, and then the 1 month would lie between overnight and 3 month. So that's interpolation, but it doesn't do much better, or maybe not better at all, right? It's about the same whether we do the one or the other, and that may be because OIS the market considers OIS to be a different market segment, right? So there's a bit of segmentation going on between those, and which may be causing problems here. Right. So by the way, these vertical lines, that's where we're now zooming in, right? So we're just looking at the cross section, right? Well, what's actually happening on the vertical line dates. So those are all these plots. And the red line here is the one that we're trying to fit, right? Where the solid red line is the market, and the dotted red line is what the model gives us. Right? And you can see that most of the time, the solid and the dotted, they're very, very close, right? So the model is actually performing quite well at extracting back out the 1 month term structure when we drop that from our data set. So now we get more ambitious. We actually try to recover OIS, right? So we have 3 months, 6 months, 12 months, or 1 month, 3 months, 6 months, 12 months. And as you can see, again, it doesn't seem to matter too much whether we include the 1 month or not. And we then try to get back OIS. Now, it's pretty bad back here, but that's actually it's GFC type territory, right? It's not that bad anymore in recent times. And so if you don't have an OIS curve, that would be actually something useful, right? But in order to do it, actually, you need some term rates at least, right? So if you get rid of your chi bar, you can't do it, right? If you only have the risk-free rate benchmark, well, none of this exercise works, right? Right. So again, here the cross-sectional plots. Now the one that we're aiming for is the blue one, and so sometimes it works well, but sometimes it doesn't work quite as well, right? Again, because now we're doing both extrapolation and we have a segmentation issue. So it's not surprising that we're not able to hit that exactly, right? Yeah, so that's this talk.
Question, Eric? Yeah, helpful.
Thank you for the great talk, Eric. When you look at the bond of fit, it is incredible. But if you look at the data, there are some spikes at certain points. So I'm just wondering whether you have jumps in the dynamics of your diffusion.
Here?
No, the other one, the first one.
This one?
No, early on the data. Yeah, those fits. So I'm just wondering whether you have jumps in the dynamics of your diffusion. And if that is the case, how is the frequency of these jumps defined?
Well, we don't have jumps in the dynamics. Right? See, we're not using jump diffusions. We're using fusions, right? I mean, jumps are certainly a potential issue, but that's actually a completely separate paper that I'm not talking. That would be a third talk, which I haven't signed up to do. The other problem, right, with this benchmark reform is that if you look at sulfur and you plot it out, it's not a diffusion. Right? So in this model, we're assuming that the overnight rate follows a diffusion. The benchmarks don't. You just look at them, right? They look more like to first order, they look like step functions. Right? It jumps whenever the Fed makes a decision. So it's a process that jumps at known dates. While if you look at the LIBORs, the term rates, they still follow something that at least looks like pretty much like a diffusion. So that needs to be reconciled, right? So you have an overnight rate that jumps at known dates, but you have term rates that actually follow more diffusive processes, and that can be reconciled. We've actually done it. Actually, we have a paper in the Journal of Futures Markets that does this, but the model doesn't do both, right? So we haven't combined it. However, Alex Backwell has a paper with Joshua Hayes in the Journal of Banking and Finance, and he combined our model, right? Because Alex was a co-author on this, with jumps at scheduled dates, and did an estimation on that. It's actually a very nice paper. So one can bring these two issues together, right? So yes, these new benchmarks, they're bringing in all kinds of changes to interest rate term structure modeling, and jumps are an important issue, especially jumps at scheduled dates. But again, it's not something that I was planning to talk about here today.
Another question?
I mean, it's more like a clarification for me. It's like, so you're basically able with this model to take those two curves and fit the difference. I mean, like because you had the plot. I mean, if you go a bit earlier, please.
Earlier, yeah.
Yeah, when you first show the LIBOR and a bit further up, right before the model itself.
This one?
No, it's on earlier. Yeah.
I don't think there's any plots further up.
No, remember when you had the
Oh, right at the beginning.
yes. So there we go. So the next plot will be what we're trying to explain, isn't it?
Yeah. Well, not quite, right? Because SOFR compounded, this is not SOFR itself, right? So there's even more. So what one could explain.
No, yeah.
If you, I mean, if we actually, well, what I'm trying to say is I don't have our model version of this plot. But one could construct it. One could construct it, right?
Yeah.
That's it. Well, what it should look like.
What fit on what you show should be able to explain this difference.
Yeah,
And if
Yeah.
you to combine them again.
yeah, and I would expect that at least on our Euro data set, it would, right? Because it's explaining all the other building blocks, right? So there's not really any space left for things to go wrong.
Okay, okay. Yeah, that's very interesting. But before the prices, if we put the model, then you had a smaller difference. So what in so the component was just the credit, right? Or the credit or the liquidity.
Well, before the crisis,
Before
the
if we were
crisis.
to do this exercise.
yeah, it would be very, very small.
Okay.
Like, I mean, well, you wouldn't be able to do it because there's no SOFR before back then, right? But if you did this,
No.
yeah, I mean, the difference would be, I guess you're right. I mean, theoretically, if you went into the repo rate data, you could reconstruct SOFR back at that time. And then the spread should solely be due to credit risk because repo is risk-free. And
Thank you.
Eric, I think that all your expectations are computed under risk information, and then you have to compute the final, you have to use common filter.
yes,
Or extended or
uncentered common filter, yeah.
unsettled common filter. How statistical significant is your market price of risk parameter?
I'd have to go back into the paper to see that. I mean, obviously we have one, right?
Okay.
Because you can't do econometric estimation without one.
Yeah.
But yeah, I mean, I don't recall.
Okay, but then again, with your methodology, are you able to see the overall risk of the rollover risk? How much percentage of the contribution from downgrade risk, and then how much from the
Well, that was, that was the point of this little exercise here.
Yeah.
This one, right? So here it's because here you have down here you have the spread, which you would get from the downgrade part only, right? And this is the total spread. Yes.
Yeah.
Yes.
Any other question? If not, let's thank Eric and let's say 10 minutes break, and then we continue again with another next stop.
When you're trying to recover the wires,
Yeah.
there are some things. This is one of the calibration of this. So the able to discover that once you move some of the parameters that you use in your model.
Yes.
And if yes, I will able to verify.
No, it's not. It's not. So we redo the whole estimation. No, we don't use the estimation with full set, right? So when we're doing this extrapolation exercise, we are actually estimating it without your as.
No, cool. Sure.
It's very interesting. Like always in the phenomenology, it's better to start with those very. Rather than.
Read the yesterday.
Yeah, no, I was thinking.
Yeah, we got that bill very.
Yeah, but you would agree.
Today we're going to be the one farm.
We've tried this. Honestly, with the chickens. Actually, I don't know that I was going to pay for that. That they were going to do.
1 year first, take the money, why not?
Oh,
And I will end up being advantage.
sure.
Yeah,
I can
yeah.
play in midfield. How do you call it?
And the moment you take your money, you don't know what happened.
Defensive midfield.
Well, yeah, yes, you substitute, you have interest rates, right? But all this multi-curve framework is completely positive interest rate. Because that's just a single curve moving.
So that I can come like this and then. Those are my position. So when really aware of the movie.
But you were gone already. No, like when we left guest house. You here earlier or you just left?
No, I was dealing with like a work thing, man. It was just, that's how I was so distracted. I mean, it's very interesting. And then now, trying to concentrate.
Because yesterday from my room, I could hear the so maybe not taking some show in this thing. But when it's very quiet from my room, I can hear also. But I was like, in this only name. And now it's why they steady. Oh, was that's very interesting. But beginning of the game. But for Super Sport, it's good to be honest. They are away. So whenever they throw, the ball is just bouncing and bouncing. Is he calling?
Okay. So it's your laptop working on.
Yes.
Why?
Because I didn't put anything. Yeah. I should. Yeah.
Okay.
Yeah.
Yeah, how do you set it? Understanding this one.
Yeah, is it 2 times 40? And it's not always 40, like 2 times 40. It's not always 40.
Yeah. You'll be laughing at us.
This guy.
Let's start.
Okay, so can you please find the file?
Okay. So the second talk will be the sector concentration risk in credit risk portfolio. Over to you, Prof.
Yeah, thank you, Matthias. So yes, so now for something very different. So this is joint work, first of all, with John Jarrett, who is an adjunct professor at UTS, and he's sort of semi-retired. He used to be quite senior in the banking industry in Australia for many, many years, so working for banks like Westpac and National Australia Bank. And so we've started to work on this together with a very practical banking type focus, right? So the aim of this talk is not high-end stochastic modeling. It's actually trying to keep things as simple as possible in the hope that it's actually simple enough to influence regulatory policy. So sector concentration risk in credit portfolios is actually a well-known risk, right? So it's basically the idea that you, as a bank, right, you're lending to many different borrowers and you're relying on diversification, right? That by lending to many different borrowers, you won't have too many of them all defaulting at the same time. And of course, that diversification, in part at least, or maybe very substantially, depends on how concentrated your lending is in particular industry sectors, right? So if, let's say, you're you're lending exclusively to mining industry, right? Then that is you're a lot less diversified than if you're lending across the entire economy. And so there have actually been cases recently, right, where banks were tripped up by this. So prominent example, Silicon Valley Bank, right, lending primarily to the tech sector, and that turned out to be quite a risky proposition. And so regulators do recognize that this risk exists, and they do have policies in place to manage this risk. But most of those measures are either quality-based or qualitative, or based on more rather ad hoc limits, right? Where basically the regulator tells you what you can do or not do, but there's no rigorous argument behind it in a way. And if we want to look at it from a quantitative perspective, well, we have to go beyond the pillar 1 of the Basel 2 and 3 standards, right? So pillar 1 does not address this topic, as the Gaussian latent factor model that is used in pillar 1 just assumes that there's a single source of risk driving default correlation, right? So there's a single systematic factor that introduces dependence between borrowers, which means that automatically you can't distinguish between sectors, right? The moment you want to distinguish between sectors, you have to have sector-specific factors, right? And pillar 1 doesn't have that. And so the intention is that the concentration risks, the sector concentration risks, should be addressed in pillar 2 of the standard. But again, that's basically limit-based. So where there are actually some sort of numbers, right, some quantitative measures to address this sector concentration risk in pillar 2, you see that actually the Herfindahl-Hirschman index, recently mentioned by NITheCS in a different context, the Herfindahl-Hirschman index plays a prominent role in terms, basically, you work out your Herfindahl-Hirschman index for your portfolio based on your sector concentrations. And then the regulator tells you how to map that to your capital, right? It just gives you numbers. And so the objective of this paper is to develop metrics for concentration risk that could be used in a regulatory setting, but with a bit more arguments, right? Actual modeling arguments behind it. And so we derive a formula that's based on standard deviation, where we assume homogeneous correlation for risk characteristics. You'll see in a moment what I mean by that. And formula that we get, which actually then uses the Herfindahl-Hirschman index, it only requires the joint default probability, so pairwise joint default probabilities, to calibrate it. And equivalently, you could use sector loss correlations, or if you have a Gaussian popular model, you could use asset correlations between sectors, if you like. Personally, I prefer the joint default probabilities because that's the most direct, right? Because the moment you introduce some sort of, let's say, asset-based type model, like a copula-based model, you're actually taking a detour. And it's a very risky detour because of the well-known shortcomings of the Gaussian copula. That's why I prefer just working directly with the joint default probability. Now, we then extend that formula to consider various percentiles. So we're starting with standard deviation as a measure, so standard deviation of the loss distribution as an initial measure of risk, but that's of course not what regulators are really interested in. They're more interested in percentiles, typically at the 99.9% level, right? So we need to look at that. And we also suggest an extension where we use a third order HHI. So with the original HHI being a second order one based on the sum of squares, we move to just saying, okay, we have a third order HHI, which is sum of cubes, which actually captures the impact of skewness of the loss distributions, which one can argue is quite important for when you're considering percentiles. And of course, then once we're moving to that level, so it's sum of cubes, then we need not just the two-way, but three-way joint default probabilities for calibration. So initially, just to keep things simple, we're doing this all under homogeneous correlation characteristics. So most importantly, that means that we are assuming that the correlation, let's say, between the mining industry and the finance industry is the same as the correlation between the finance industry and the insurance industry, which is probably not a very reasonable assumption. So we move away from that and introduce and make at least those correlations between sectors inhomogeneous, and would suggest that actually though the formulas that we get out in that case are the ones that would be most applicable in an actual practical setting. Right, so just as a simple example for motivation, and I mean, anybody who's ever worked with this sort of stuff, this is probably a very boring and trivial example, but I'll just go through it just as a matter of introduction anyway. So we'll just consider very simple two portfolios, and we assume that we just have two independent sectors, and in the diversified case, we lend as much to one sector as to the other. And in the concentrated case, we put 90% of our eggs in one basket and 10% in the other. And then we can calculate the, so we then use a Gaussian one-factor type setup with that probability of default 1%, loss given so no recovery, loss given default of 100%, and an asset correlation of 20%, and then calculate the risk measures as a percentage of the portfolio notional, right? That's what these numbers mean. So the standard deviation of the loss distribution in the diversified case here would be about 1% of the portfolio notional. The concentrated case is 1.4. And as we move further out into the tail, of course, the concentration really kicks in, right? The difference between diversified and concentrated is much more substantial. And we can, those same numbers we can just put in the plot, and we can see that how the concentration of our risks actually results in higher risk measures for our portfolio loss distribution. Okay, so as I said, we start off looking at standard deviation, right? So the standard deviation of the portfolio loss distribution under the assumption that we made. And that can be calculated based on the joint default probabilities and the univariate default probabilities. So that the PIs are the univariate default probabilities. The SIs are the sector weights, right? Which we can, without loss of generality, we can consider them to add up to 1. And the J's are the pairwise joint default probabilities. So JII means that that's the joint probability of two obligors in the same industry sector defaulting, while JIJ we're going across sectors. And if we assume homogeneity, that these things, then we have just, then all the JIIs, regardless of I, are just a single JW so W for within sector. And all the JIJs are just a single JA for A for across sector. Right? So it reduces down to this. We have our Herfindahl-Hirschman index, and because we are normalizing our weights to sum to 1, the Herfindahl-Hirschman index for this is just the sum of the squares of the sector weights. And then bringing all that notation together allows us to express the standard deviation of the portfolio loss distribution in this very simple form, right? In terms of the Herfindahl-Hirschman index and the disjoint and univariate default probability. And again, I mean, we're doing this because regulators like simple formulas. Now, furthermore, we can consider the ratio of the standard deviation of two different portfolios, right? So the most, basically the standard deviation of some arbitrary portfolio with some Herfindahl-Hirschman index versus the standard deviation of a portfolio that is as diversified as possible, meaning where the weight is just 1 over the number of sectors, right? 1 over n. And so then we get this expression here. So the ratio, the concentration ratio, is this very nice function of the Hirschman index of our portfolio, right? Where the alpha has this form, but that's just based on model variables, right? So when we actually just do our our allocation across sectors, the only thing that we're controlling is the H2, because this alpha is just exogenously given by the data, by the market. And we can also, if we want, express that in terms of the sector loss correlation, where the sector loss correlation can be calculated in this fashion. Right, so this formula certainly is potentially useful, right, for determining the effect of concentrating our risk, right? So as we concentrate our risk, we increase our Herfindahl-Hirschman index, and that then directly maps to this ratio of portfolio loss, of standard deviations of the portfolio loss distribution. And because this is expressed in terms of default probabilities, right, there's no Gaussian copula issue, right? We don't have to worry about the problems with the Gaussian copula here. And one thing to note is the effect of the Herfindahl-Hirschman index on this risk metric is quite dependent on the level of correlation. And it's important to remember actually here that if we are talking about concentration penalties, and we're using some assumption of sector correlations to calculate the correlation penalties, the capital penalties, right? So the concentration penalty that is applied by the regulator for being too concentrated in one sector. It is less conservative to assume a high correlation, which is sort of it's a little bit counterintuitive, because in normal situations, if you're looking at portfolio loss distribution and you're modeling that, you're modeling your portfolio, the loss of your portfolio, having underestimating the correlation is a problem, right? So if the higher the correlation you put into a model, the more conservative you are, because you're just expanding things out in the tail. But here, because we're actually determining the impact of being more concentrated, it's the other way around, right? Because if everything's perfectly correlated, there's no reason to apply a concentration penalty, because you don't get any benefit from diversifying across sectors. But if they're independent, then you do get a benefit from diversifying across sectors, and then you get a much higher impact on the as you increase your concentration on this particular concentration factor. Now, the ones who've been most explicit, actually the only ones who've been really explicit about mapping sector concentrations in bank portfolios to capital add-ons are the Prudential Regulatory Authority in the UK, the PRA. So they actually employ a multi-factor model based, for example, on the work of Dillman and Maschlein, calibrate that so that the capital requirement for a well-diversified portfolio using the model is the same as what has been put into the standard, into the Basel standard without any model, right? or sector concentration, and then looks at the capital requirements under a sequence of more concentrated portfolios, compares that, so maps that to the Herfindahl-Hirschman index of the portfolio, which is calculated based on the portfolio share using risk-weighted assets. And that then results in a table, which I'll show you in a moment, mapping the H2 of your portfolio to capital add-ons. So additional regulatory capital that you have to reserve if you happen to be more concentrated than the regulator likes. And actually, we can, with our approach, quite closely match the PRA table. So we use 9 sectors, as the PRA also do, but we make them risk homogeneous. And if we then use an alpha defined as a few slides back, of this number, which actually corresponds to a correlation, sector loss correlation of 51%, then we get this, right? So we've got our concentration factor, and we divide that into buckets, and we map those buckets to the PRA's buckets in the PRA table. So these first 2 lines those are from the PRA table, right? So these are our corresponding buckets. And when we then calculate the capital add-on adjustment based on our concentration factor, we get numbers that are quite close to what the PRA does. And I would actually suggest that our numbers are in a way nicer, because if we plot this, so the red, that's our mapping, and the blue is the PRA mapping. And I think there's no, to me, there's no conceivable economic reason why you should have this sort of wavy relationship, right? If this was some sort of curve, right, convex or concave curve, you could say, well, maybe there's one could come up with some modeling reasons that why that should be the case. So, and then we would be wondering why we couldn't reproduce that. But not something like this that waves around, right? So in that sense, what we have here with the red curve is basically the PRA table, but now as a continuum, right, rather than as a discrete table. And more explainable, right? Because I've told you actually how I got it. Now, on the calibration, you should recall that I said that in order to match the PRA numbers, we had to assume a sector loss correlation of 51%. And if you go to empirical studies in the literature, in particular, there's a study by Sevigny and Renault, who actually, the 51% is actually quite high. Well, one thing is, of course, that's a pre-GFC study. So maybe if you do an estimation including the GFC, you might get a higher number already. But more importantly, actually, if we have 51%, we're actually being less conservative in a concentration context than more, as I explained, right, a few slides back. Because the penalty, the capital add-ons that you do, they are less if the sectors are more correlated in your model. And also, this needs to be balanced against other factors, right? If you, first of all, the PRA mandates based on the table capital add-ons the moment your portfolio is not equally sector weighted, right? So the moment your HHI departs from the 1/n, you get a capital add-on, which we think is a bit problematic, right? Because the regulatory framework, so Basel basically says, is that your benchmark should be your your average bank portfolio, right? It shouldn't be, and I don't think any bank is that diversified. Is that because the 1/n is the maximum diversification across sectors that you can have. I don't think any bank has that. So in that sense, that makes this PRA approach already more conservative. And furthermore, the calibration of the Basel asset correlations in the first place may have been a bit more may be more conservative to start with, and also there are other features in the PRA approach, including judgmental aspects and the interaction, of course, with other add-ons, because this sector concentration one is not the only add-on that will serve to mitigate risk. However, if we suppose that we actually don't take the perfectly diversified case as benchmark, but rather, let's say, an H2 of 50% as the benchmark, which is totally arbitrary, right? I mean, we didn't look at what the right benchmark in terms of H2 should be. But if we do that, then you get not just capital add-ons, but you also get subtract offs, right? So the moment the perfectly diversified case is not your benchmark, then it is possible to be more diversified than your benchmark. And that means that you should actually, in a fair world, you should be required to get benefit, right? You don't have to reserve as much capital as everybody else, right? So it's a subtract off rather than an add on. And that's expressed here by the numbers in brackets. So any number in brackets that's a negative add on. So a subtract off on the capital. And all other things in there are the same as in the previous table, but now we've just moved benchmark, right? We moved the goalpost. Now, this alpha, so recall that the alpha that we were choosing, that of course was a function of joint default probabilities and so on, right? And how you get that particular alpha actually depends on the level of univariate default probability, right? So we were using a Gaussian copula module, right, to produce the joint default probabilities using a particular correlation number. That was the 51%, right? So how you get that, however, depends on how risky your portfolio is, because the lower the default risk, the further out in the tail of the Gaussian copula you are, and because the tail dependence in the Gaussian copula goes to 0, you actually need a much higher correlation for high quality, in the case of a high quality portfolio, than in the case of a low quality. And that's what this expresses. So if you have a default probability of 5%, which is 5 basis points, then you would need, so this is the intersector correlation of about 17%. And if the probability of default is 10%, that only needs to be 6%. This is actually so we're doing this, and this is something that's well known to regulators. Because if you go into the regulatory documents, they tell you in other contexts, right? Where, I mean, they don't use the Gaussian copula model for this purpose, but in Pillar 1, they actually tell you that if you are further out in the tail, so if your default probability is low, you have to use a higher correlation. They don't tell you why, right? That doesn't, so the explanation is not there, but anyone in the know knows this is because they're allowing you to use the Gaussian copula model, and the regulators very well know the problems with the Gaussian copula. That's why they have this mapping between probability of univariate probability of default and the correlations that you need to use.
I want to ask a question.
Yes.
Again, then why not use a copula that has the tail dependency needed?
So where you would get constant across.
Yeah.
That would be good. And one thing that I've never got around to doing, but one day I'm just going to do it because it's small. It's not a big exercise. is if you use a t-copula and then look whether there's a sweet spot, right, where you can, of the choice of the degrees of freedom of the t-copula, where this becomes pretty more or less flat, right? I've never had a chance to look at it. They don't do it because the Gaussian copula, even though it's the formula that killed Wall Street, right, according to an article in Wired magazine back just after the financial crisis, the Gaussian copula is an industry standard. Everybody uses it. Just like everybody uses Black-Scholes, even though we know it's wrong, right, because it's a volatility smile. So here we have something like that, right, a correlation smile. It's not a smile, it's just a monotonic curve, but yeah. Right, so that was okay, but of course, as I said earlier in the beginning, what we're really interested in are these percentiles, and rather than just the standard deviation of the portfolio loss distribution. And quite often one thinks of these percentiles as just the mean, how many standard deviations we have to go away from the mean to get to our percentile, right? So this lambda is the number of standard deviations that we have to go out from the mean to get to our target percentile. And for regulatory purposes, that's quite far out, right? It's 99.9 percentile, so the lambda will be not that small. And we can again then look at the ratio of how far we go out. So so how many standard deviations we go out in the concentrated case versus the fully diversified case, right? And obviously in the fully diversified case, that's the lowest number that we have to go out to reach a particular percentile. So in this table, we now look at the impact of changing the H2 on this multiplier lambda. Right? So this column and this column are the most interesting one. And unsurprisingly, if we increase the H2, right, meaning that we get less diversified, this multiplier increases. Right? So the way we did this is right, to keep as much things equal and just vary the H2. So we have our 9 sectors. We assume that 8 of those sectors have the same weights, right? And then we just vary the last sector as a percentage of, as a proportion of the total to get the target H2. Yeah. So unsurprising this. But the thing is that just a simple exercise shows that the H2 is not enough, right? Because if we then go off and let's say we hold H2 fixed and we vary H3, again, we see that the multiplier increases as we increase the H3, even with the H2 constant. So there's a problem here, right? Because the PRA only uses H2 to do the mapping. So it does not take into account this, right? And I mean, it's fairly obvious, but it hasn't made it into regulatory policy. So what do we do? Well, we can look at this at the third moment of the portfolio loss distribution. And if we want to calculate that, then we need the 3-way joint default probability. So we call them these T's, right? So this is where all 3 are within one sector. This one is 2 within one sector and 1 across, and this is all across. Right? So in a homogeneous case, that's enough. We only have those 3 cases, right? So then if we introduce our H3, then we can actually express the skewness ratio between our concentrated portfolio and our diversified portfolio, again, in similar nice, simple formulas, now in terms of the H2 2 and the H3, where these alpha coefficients, they are just exogenous, right? They're just defined by the default probabilities in the market, right? So the nice thing about this formula, there is of course a lot of complexity hidden in these alphas, but that's just stuff that's fixed by the market. It's not under our control, right? It's the concentration factors, the HHIs, that are under our control when we put eggs into different baskets, right? And now is where it really gets interesting, and I just wonder whether I can move this that you can see, but it's not. So this thing down here is really in the way.
Drag.
You can grab it.
I can grab it, okay. Don't have a mouse, so let's see whether I can grab it without a mouse. Oh yeah. Okay. Right. So this is the part where we're really targeting the regulators, right? Because they like the simple formulas. And we find that if we look at our skewness ratio, the log skewness ratio, and regress the multiplier ratio on the skewness ratio, we get a very, very close fit. And now this has, of course, all been generated by Monte Carlo. And so we don't have a mathematical proof that this relationship is linear, nor do we have a mathematical proof at this point in time that the relationship is approximately linear. But it does seem to be very close enough for government work. So it could even still potentially be that it is actually linear, because this is all generated by Monte Carlo, so that all the variations are Monte Carlo nodes. But at this point, that's still work in progress. Right. Oh, now I've lost focus, I think, on the slide. Oops.
So the big sort of innovation here is using the H3 on the skewness side.
Yeah, the H3 is in the gammas, right?
Gammas, yeah.
Yeah, now it works. So using this improved formula, in order to fit the PRA numbers, we're still able to fit the PRA numbers, but we have to move even higher with the correlations. But okay, be that as it may. Right. So the whole point of this is that the value of using such a formula, be it for the standard deviation or the percentile, is that we can determine the concentration factor and the add-on for any portfolio or sub-portfolio composition and parameter set, and we understand the sensitivities. Right? It's much more explainable, but still nice and simple, right? The formulas are not way out there that you couldn't put it into a regulatory document. Right. Now, final thing is the non-homogeneous case, right? Because as I was saying in the beginning, it's perhaps unreasonable to assume that the cross-sector correlations are all the same. And that makes a big difference, right? Because suppose you have 9 sectors, 8 of them are reasonably closely correlated, and the final one is independent of all the others. Then equal weighting is not the best diversification. So therefore, for the purposes of sector concentration risk, what matters most is to consider non-homogeneity in the between sector correlations. Right? So that's what we're doing here. So we're still keeping the within sector correlation the same across all sectors, but one could, if one really wanted to, generalize that. However, now, instead of having a JA here, we now have different JIJs, depending on which sector pair we look at. So then the formula becomes slightly more complicated, right? So we've got this, so this part was the original formula in the homogeneous case, and now we've got this correction term for non-homogeneity, right? So now it becomes really a matter of taste. Do we want to keep it really that simple? We have just the front part, or are we still happy with this formula? And that takes care of the biggest non-homogeneity problem that we had, right? It covers the key point of non-homogeneity if we use this formula. Right. So this, of course, now shows that the concentration factor is quite dependent on how these correlations of the sectors are relative to one another, which I've already given you that example. So this slide is just basically saying that same thing, right? That once we have inhomogeneous cross-sector correlations being equal weight in each sector is no longer the optimal diversification. Okay, so we can look at this and now consider maybe two cases, right? We have, and the case I consider that I call low is where, so remember, the way I was doing this sort of exercise is to hold the everything fixed except for the H3, right? And I do that by varying basically the weight in one or two sectors. Right? So if we're keeping if we're varying the H2, then we keep then we vary the weight of only one sector, and all the other ones are equal. And so we get a low case if that additional sector where we're now concentrating in has a low correlation with everything else. While if the sector that we're concentrating in has a high correlation, right, then we get into the high case. And you can see that how that impacts on the add-ons, right? So here we have actually a subtract off, and here we have an add-on even in the lowest H2 bucket. Okay, so remaining question is what happens to our nice linear relationship that we were seeing before? So working out our skewness ratio, doing our mapping, same exercise, still looks very linear, right? Meaning we still, now with quite different coefficients, but we could still, even in the inhomogeneous case, right, if we use the formulas that we now have, we can map the skewness ratio that comes out of the formulas that we have to the multiplier ratio, and that still looks very linear, which is nice, right? Because you just then take that formula, calibrate it, put it into the regulatory document, and everybody can use it. They don't have to understand anything beyond arithmetic, right? Right. So these are just the details of how we come up with those plots, right? So it's based on Monte Carlo simulation nested, right? So we're within, so we calculate the multiplier, true multiplier in one particular scenario based on 1 million simulations of the portfolio loss distribution. And then we do this over 10,000 different parameter constellations, right? So each dot basically in that plot was a different parameter constellation. And that was based on an estimate resulting from 1 million Monte Carlo simulations. So to conclude, so we've developed a framework for sector concentration based on metrics which we think are simple enough to be suitable for regulatory setting. So the approach is based on the standard deviation of the portfolio loss. So first we're looking at the homogeneous case and start with just using the H2 only as the PRA do. We then move on to show that even in the homogeneous case, the H2 is not enough. We need the H3 really to capture this properly. However, if we believe those linear plots, that means that H3 is enough, right? Because that would be the next question. Well, okay, well, what about H4? We don't need it, right? Finally, then we generalize all this to the non-homogeneous case and see that actually this nice linear plot seems to hold up, even if we relax the assumption of the same correlations between sectors for all sector pairs. Right, so here are just the papers that we cited. So PRA's methodology is in the first document. The correlation numbers that I cited are in the second one. And this paper itself is available on SSRN.
Any questions for Harry?
I'm struggling a little bit to get the difference between that concentration and correlation, because in my impression will be that the correlation, I mean, like if you can try and have no concentration, but still have correlation. Right. In other words, I mean, like if I just look at two different sectors, they can be more correlated than asset within the same sector. So how do we split the two? I mean, I think I'm missing that in terms of
well, the regulatory assumption, and actually, I mean, papers like de Sevigny and Renault sort of bear this out, is that if you properly define your industry sectors, then the within sector correlations are higher than across sector. Right? Otherwise,
definition of sector. Okay.
Yeah. So if you badly define your sectors, then you might get exactly that effect. Yes. And again, the correlations they're just exogenously given, right? There's something that you can estimate from the data. It's not easy to estimate from data, but they should be data driven, right? So what you control is the concentration. And that's what then, so we need a mapping for regulatory purposes, we need a mapping. So the regulators should be going off and estimating this stuff, right? Don't leave it to the banks. So come up with the coefficients, right? But then you've got a mapping from your sector weights in your portfolio to the capital add-on. Put that into the regulatory document. Right? So what the banks can control, that then determines their capital add-on.
Thank you.
Any other question? In the table that you're getting beta for homogeneous and non-homogeneous.
Yeah.
Especially for P 0.5 and P 0.5, there's not much shift. Is the explanation to that?
No, because we don't really know even why this relationship is so nicely linear. That's work in progress. But I mean, it may very well be. I mean, if you look at these numbers, it could be that the difference between the betas in the first row and the betas in the second row are just Monte Carlo error. I mean, that would be the perfect result, right? That this linear relationship is totally that sector concentration is totally irrelevant. Or sorry, that sector inhomogeneity in the sector correlations is totally irrelevant. The skew coefficients themselves, right? They are going to depend on this because you saw the formulas, right? So it would just mean that the way we calculate our gammas based on the sector correlations fully captures any correlation in homogeneity. That is true, then we would get the same numbers in the first row and the second row. And we don't yet know whether that's strictly true, but it does seem to be true in approximation, right? So it's we do seem to be capturing a lot, and that's the whole point here, right?
And does this result apply to other copula models like T-copula?
That is a good question, and that is actually the top top of the list for exploration. We haven't done it yet. So the plots, these linear plots, right? The scenarios and the Monte Carlo is generated using Gaussian copula. And I'm going to, for sure, switch out the Gaussian copula, put in a T copula, and see what happens as I change the degrees of freedom on the T copula. That's definitely it's on the agenda.
No questions, and let's thank Eric. Right now, come back at 11.
Okay, thank you, Ms. Yes. Where is this? Sorry.
IBD, investment bank division, and then the global markets. Then the investment bank division, they will do deals set to help bonds and big loan.
Is this the clicker?
Global markets, it's where you do the trading. Well, so the trading desk will just do small traders, then trader FX, commodity swaps, and all. Yeah, it's probably. Yeah, it's stuff. Funds in order to fund available directly fund to trade, can do structure, can do market risk, can do risk management, we can do aggregation. Yeah. Wait, where are those students? They just like so long. Just chilling.
But let's see, they said percent. That's an actually 3 months. 30%. Good. But then they bring this 4%. So we may see that.
Yeah.
Taking into consideration the big.
Yeah. Yeah.
We'll give me the chat later.
That's why we here. No fun, yeah.
So our next speaker is now from Agency Group, which is the head of fixed income there. And I'm very honored to have him here. So that I just reach out to him via LinkedIn, then from there he'll very kind to reply to me. And he's very keen to come and talk to us about some of the work that he's doing there. And we're very honored, really looking forward to your talk on this.
Thank you. Okay, good morning, everyone. I think I'll put a background before we kind of start, right? I mean, as the topic says, it's looking essentially, at fixed income, but trying to kind of unpack some of the, I won't say mystery, but some of the anomalies we pick up in terms of how yield curves are actually priced, and how do we reconcile that to the macro information? Well, the information the market uses in order to establish what the correct sort of like yield should be in a fixed income context. So where this idea sort of came from, so apart from fixed income, I also run multi-asset investment portfolios. And a lot of the strategy in those portfolios relies on essentially the asset allocation. So the construction of the portfolios, right, at a very high level, we determine an asset class sort of mix, and then within those asset classes, we then have to use a tactical sort of strategy in order to generate outperformance. Okay. Now, in that tactical sort of asset allocation strategy, it relies a lot on actually understanding the macroeconomic environment is one. And then, we then dig deeper into things regarding valuation of sort of securities. And then also trying to then explain things further using some sort of at a third level, using essentially your sort of economic policies, right? That be it from the fiscal side, right? That will sort of govern more the macro. And then on the monetary policy side, which is effectively trying to essentially provide levers for your growth and inflation controls. So that's where kind of this idea came from, was to say, okay, right, because I predominantly work in fixed income, I'm trying to sort of reconcile, how do I explain my returns in the portfolio, right? With information that pretty much, I look at the yield curve, and is it enough for me to really truly understand where the excess returns are coming from, or are there missing elements, right? And the follow-up to that is there an instance where the market and the information that the market gets from the macro, can they sort of be misaligned such that it creates an opportunity for us to exploit, right? So that's the idea behind sort of the talk today, is to sort of identify if indeed we have potential misalignment between the market and the macro. Okay, so from an introduction point of view, as I said before, right, we've been looking at fixed income. So essentially, in the market, right, we have these things called yield curves, right? Some of you are familiar with yield curves, right? But in reality, I mean, it does not always reflect what's the information that's sort of coming from the sort of macroeconomic data, right? So studies, Farmer and Bliss and Schiller back starting in 87 and 91, right? Despite seen as forward-looking, as the yield curve, sort of is typically used, right? It often misprices turning points. Macroeconomic data contains predictive power beyond yields, right? So if you look at the yield curve itself, the way the theory tells us, it's sort of spanned by three factors. You've got the level, you've got the slope, you've got curvature, right? That in essence was meant to explain really most of the variation in sort of the yield curve. But studies have shown, right, that essentially these unspanned macro factors, such as your growth or inflation, can contribute to actually understanding or rather providing predictive power for excess returns over and above those three factors I mentioned of the yield curve, right? We also know that regime dynamics alter the macro yield relationship. So for instance, I mean, theoretically, in response to certain sort of macroeconomic shifts, right? If you are moving into a contractionary sort of economic cycle, there is a reaction in the yield curve, right? The yield curve will typically start to sort of change its shape, if you want to call it that, right? And in that shape change, you would see some steepening effect or flattening effect, and also there's the case of whether it's a bear or bull sort of response. Is there a certain preference on the yield curve that people sort of like to safety in terms of preventing sort of macro risk? So the regime dynamics, they alter the macro yield relationships. That's the important thing, right? So the term structure behavior shifts across the macro regimes. And then, of course, markets underreact around macro transitions. So, we kind of do see, and then again, also in the analysis, we will pick it up, but the yield curves themselves do lag during a crisis or any policy shifts, right? Which, ultimately leads to a point this is not a point, which essentially is something that I want to sort of unpack today, this divergence between what the market, sort of the belief versus the reality the macro is actually saying. Okay, all right. Okay, so from a literature context point of view, okay, I think this is kind of, there's a lot of work actually has been done to try to understand this idea of misalignment, if indeed there is misalignment, and also whether, does the yield curve itself explain bond returns, essentially like, in a complete way. And of course, it's not the case. So the yield curve itself reflects expectations, but not always the fundamentals. These latent yield factors, right, help forecast bond returns. So for instance, in the yield curve itself, right, we could use the yield curve to explain bond returns. So Cochrane and Piazzi in 2005 came up with a certain factor, right, which essentially looks at the forward sort of rates and creates a measure, right, taking a weighted average, a specific weighted average. And they found that that factor itself has, sort of power to explain excess bond returns, or at least forecast excess bond returns, right? Macro PCA factors explain excess returns missed by yields, right? As I said earlier, right? I mean, some of these models, they're very good at explaining perhaps short-term excess returns, but over the longer term, they kind of get weaker. And this is kind of where the macro sort of macro information plugs that gap. Unspanned macro risks, as I said before, can influence term premium. So, for instance, when you look at sort of the risk premium on the yield curve, I mean, as you know, we essentially understand the longer you invest, or the longer sort of maturities on the yield curve, they're associated with term risk, right? But that term premium that we sort of, the compensation that we demand for taking on additional risk, in effect also, right, is, well, the returns that we get is essentially coming from sort of these unspanned macro risks in addition to any sort of curve compensation. And as I said before, the yield macro relationships they basically move with the regimes, right? So regime identification, right, is quite important, because I think in the context of the bond returns, being regime aware allows you then to understand what sort of reaction you expect the yield curve or the shape of the yield curve to undergo. And, depending on the strategy that you're going to use to exploit that for the time that you have that misalignment between the macro and the yield. So yeah, the literature is quite dense, but it does pick up a very important point, is that the yield curve itself, used by itself, is not enough to actually explain excess bond returns. There is another element, right? These unspanned sort of macro sort of risks, right? That can be used to essentially help you predict, forecast excess bond returns, and they become even more sort of useful when you essentially identify that misalignment, right? So what I've tried to do, right? What I've tried to do was approach this problem in a specific way. So if there is an alignment, how would I measure it? So that's the one sort of key aspect. And then the other aspect is, what am I actually trying to sort of explain here, right? So what I want to do fundamentally is I want to be able to sort of identify this regime that we're in based on the macro information, right? Okay, and then at the same time, on the market side, right, which is essentially the yield curve and sort of the fixed income market, right? I want to be able to take that information, right, ignoring the macro side of things, the fundamental part, try to identify also in a regime context, what does the yield curve or the behavioral changes of the yield curve suggest what regime we're in. So I've got two sort of ways of getting to this idea of regime identification. One's going to come from purely the macro information. The other is going to come from the market. Macro I see as reality, and I see the market as the belief, the expectation. So the two essentially are going to try to get to a means of identifying what regime we're in. And then based on that, right, we're going to try to identify, okay, are we in agreement or are we in disagreement in terms of our regime sort of awareness? Okay, so the macro and market implied regimes, right? The research hopefully will try to explain this, right? But what I found is that there is no sort of systematic sort of comparison between the macro and the market, right? Divergence may look at the divergence that I spoke about, that difference may forecast excess bond returns. And the existing models treat macro and market regimes separately rather than in one framework. So my goal is to basically unify the two and to come to some sort of measurement that allows at least to provide a better diagnostic of what's happening in the fixed income market, to hopefully either explain risk premium better, maybe identify inefficiency in the market, as well as try to identify whether we can forecast excess bond returns. So how I'm going to do this? All right. So conceptually, I think this is a better way of actually explaining it. I'm going to look at the two different sort of pieces of information. Macro sort of information, the reality part of it. This is kind of your information you get from macroeconomic data, GDP, inflation, unemployment, etc. So you get basically all that information, right? We're going to run some PCA sort of analysis on that in a specific way. Right? From there, we're going to try to use that information to essentially identify a regime, an economic regime, and I'll show you how we do that. And then eventually come down to some idea of a probability distribution of being in a certain regime. Okay. That's from the macroeconomic information. In the market, right? I forget all that. I come to the market, I look at the yield curve. And from the yield curve, we're going to use the yield curve, right? Features of the yield curve. For instance, I mentioned what spans the yield curve itself in terms of levels of curvature. We're going to use those features. We're going to incorporate some level of volatility as well, because with the volatility, you need to understand what the reaction would be in a market that perhaps could be sort of bearish, right? What effect it has in terms of the curve shape, and then persistence in the sense of the structural sort of shape of the yield curve. We're going to use this information, so we're going to feature engineer quite a bit here, with the goal of creating a sort of classifier. Right, the information from here will provide us a sort of a classification model to allow us to sort of get a market implied regime probability. Can you see that there are two sort of ways to get to this sort of regime probability? But the idea is they're coming from separate sources, right? And then what we're going to do ultimately is that we're going to create this sort of, this is the idea, going to sort of measure this difference, right? I call it a divergence, macro market divergence, by considering the probability, like in terms of a variational sort of measurement, what the difference is in regime, right, of the different probabilities, to identify, is there a misalignment or is there an agreement between both reality and mean. Okay, so methodology. The hard part. All right. So identifying the macroeconomic regimes, that's now essentially the goal, right? You're going to do it separately, right? And for both the market and for the macro economic information, right? On the macro side, we're going to start with the principal component analysis, do some sort of clustering, right? And then essentially build a hidden Markov model. So it's going to allow us to get a sort of a smooth out posterior probability path, right? That gives us basically a temporal sort of path, so like through time, right? That will allow us then to sort of track our posterior probabilities of being in regime. Right. And the second part is we're going to infer the market implied regime probabilities, as I said, using a logistic classifier, right? And we're going to train it on certain features, for example, the slope, the level, the curvature that comes from the yield curve, as well as other sort of like, I would call them like financial features, volatility contributions that either come from yield curve sort of changes in the forward rates, as well as using some well-known indices like the move index, right? To help us essentially discover a latent sort of single factor, a latent force driving volatility. And then we do something quite interesting on the persistence side. We kind of do a bit of Z scoring, but focusing on rolling windows of how sort of changes across the yield curve. What we are essentially trying to do over here is trying to show structural persistence. So, for instance, if the yield curve has any pressure to flatten or steepen, right, is it generally in response to perhaps changing regime, or is it just sort of usual sort of market reaction? With these two sort of sets of information in mind, we're going to construct this macro market divergence. And as I said, right, it's a measure of the total variation. And then the goal of the research, toward the end, is to essentially try to explain macro market misalignment, and then hopefully use it as our measure of the goal, at least, is to measure some level of inefficiency in the market, and also as a tool to help us understand risk premium sort of pricing on the yield curve that is informed by macro information. In terms of the data, right, my data set starts from 2002 to 2005. Where it's sourced is sourced of Bloomberg. It is all essentially US sort of macro and yield curve data, right? As you can see on the yield curves, I'm using US Treasuries, constant maturity sort of yields from 2 years out to 30 years. I use the move index, which is kind of your VIX equivalent in the fixed income space. And then I've got custom forward volatility calculators that's essentially just looking at forward bond yields and their volatilities, right? So it's important to understand where the kind of the pressure is on the yield curve. Essentially, if you look at the yield curve, you've got 3 different sections. You've got the short end, you've got the bed end, you've got the ultra long ends. They each exhibit different levels of volatility depending on activity in those parts of the yield curve. And then again, as I said, that activity is by and large driven by behavioral sort of aspects. And in regime, those behavioral aspects can change. And of course, yeah, data integrity. I mean, the way the data is feed, it's aligned to a monthly frequency. There is a bit of a caveat with that. I'll explain that toward the end. But essentially what we're going to do, right, we are going to run some sort of PCA transformation on our macro information, right? And we're also going to ensure some stationarity. So there'll be a bit of testing on that, statistical testing to ensure we have stationary conditions. And what we need to do essentially is basically get ourselves ready, our data ready to satisfy the emission distribution requirement that's going to be fed into the hidden market model later on. Okay, my stuff is not as hardcore as your guys' stuff, so pretty, I think, easy to explain, hopefully. So, how do we do this? So on the macroeconomic side, the goal, identify the regime, and eventually come down to, do you want to get to a level of a posterior distribution, right, that we want to use in the divergence calculation, right? So how do we get to that? So the first step, inputs, we've got, as I said, we've got macroeconomic data, which we will block up into different categories, right? I'll collect all the growth variables, all the labor variables, all the inflation variables, right? What I'm going to do then, I'm going to do this feature optimization, right? When you run a PCA, I'm going to have a bunch of principal components. Essentially, it becomes very difficult to try to keep all of the pieces together because then it makes the problem a bit more multidimensional and difficult then to visualize. So what I essentially did was all the growth variables, I identified a subset that essentially gave me the most variational explanation, single latent driving force for each of these different categories of macro blocks. And I essentially take the first principal component. The way I decide on what goes into those sort of blocks, there's a means of actually calculating what those blocks, inside those blocks, how much of variation is actually explained by a subset, right, from the PC1s, and then the sort of threshold, kind of the minimum explanation of what the variance explained, I set it at 70%. So I've got a fairly representative, call it latent driver, right, in the PC1s for each of these different macro variables. Okay, so I essentially set up this triplet, right, of PC1s, right? Now, before, actually, maybe let's start here. Now, how do I then use that information? Now, there's been a bit of discovery in the research in terms of my own sort of like understanding of how to effectively cluster, because you can't just suddenly just like get the information and think, okay, I'm going to stick it into some sort of clustering algo, and I'm going to effectively cluster, and I'm going to get a good idea of what regimes we're in, right? So your clustering methods actually play a big role in finally getting to the regime identification. So like, I'll come back to the slide. I'm going to show you what I'm talking about. So if we initially cluster, right? Just initially cluster using k-means. So all that macro information, as I said, you've got three principal components, three variables, PC1 sort of variables, and we do a k-means clustering. Now, what does k-means clustering mean? We try to minimize. Yeah, so like within cluster, we're trying to minimize that variance to the center of the cluster, right? Or rather the distance, right? So essentially what's happening here is you can see a bit of bunching up right here. This is not k-means yet, but there's a bit of bunching up in information, and this is our outliers. But you can clearly see here, right? These principal components are too close to each other in terms of the data. So immediately I can tell that when I do the clustering, I'm going to have a problem, right? In terms of identifying cleanly, like what sort of group of these variables belong to a distinct cluster. So immediately now from this, I'm going to have an issue, and I can actually see it in the density charts, right? I'll just do sort of like for growth, you can see these huge spikes. They're basically telling me things are quite tightly packed together. So it's going to be kind of problematic to just kind of run through a k-means clustering algo, because I'm not going to effectively or distinctly be able to identify regimes. So that became a bit of an issue. right? But just, fine. So let's go back to the method, right? So what I had to do was, to get around that, right, I transformed the problem a bit. So I said, okay, fine, instead of being sort of aware to the magnitude of the principal components, I've got to understand, like from the theory, what does it actually mean, right? If we're in a contraction or if we're in a particular economic regime. So I look at the direction of the data. For instance, in a economic contraction, we'd expect growth to be negative, expect it to be pretty much a disinflationary environment, and you expect labor to be weak. So in terms of the values, yes, all negative, but the direction actually was more important than the value itself. So what I then focused on was trying to transform these magnitude sort of values to something that's more directional. So I project these things now on a directional basis, right, onto a unit sphere. And then what I do is I try to align a lot of the different sort of components, right, that share similarities in that direction. So by doing that, it actually helped me resolve that issue of the bunching, because now I'm looking at the problem from a directional point of view instead of from a magnitude point of view, right? So this is what I call this cosine clustering does. There's a measure of similarity, and then from here, right, we then use this update to try to help us then identify the cluster, and then we cluster according to these rules. Okay. So far, so good. Right. So I'll come back to the rest of that now. The actions. So based on the PC1s, as I said earlier, right, why I use the PC1s, the way I feature optimize them, right? They're quite representative of the data. So just to give you context, this is sort of your time series of the PC1s for growth, labor, and inflation. These bars here essentially is the periods in the US where there was a recession, right? Bear in mind, my data goes from 2002 to 2025. This is a period of recession. This is a period during COVID. And you can see the behavior of PCs, right, essentially, right, especially over here during COVID, how these sort of move. So I'm happy that, you know, at least 70% of the variation in those macro blocks are being explained by the first principal component. I'm happy to use that because I'm getting a good directional sort of response from that, right? In terms of the outliers, right, I use this the Nobel sort of outlier metric, right? But beside the point, right? It was able to detect, right, in the in-sample, or rather my training sample, right, the periods of outliers, and then it coincided with the GFC. So I'm happy that the outlier method that I'm using for identification is consistent to what we actually experienced in the past. Okay, we spoke about this. Now the bunching became a bit of a problem. So this is exactly what I was talking about. When you use something like K-means, and I use 6 regimes in this instance, right? You get this problem here with a bunching, right? So you can't clearly tell what, I mean, the clustering itself is too unclear. It doesn't really make sense. I tried to orient the principal components to get an idea to explain what sort of regime they should belong to. So I've got the labor axis, the growth axis, right, and the inflation axis, right, coming on, but you can't clearly make any sort of clean distinction of what regime you're in, right? So it became a bit of a problem, right? So I ran this with 6 regimes, and I thought, okay, maybe I could resolve the issue by potentially, you know, censoring 2 regimes that were too extreme. For instance, the sort of a boom type of regime when the variables are off the charts, and then the crisis regime, as we saw with GFC and COVID. But it didn't really help the situation there at all because things were still tightly bunched. Can't really tell much, doesn't really help. So then I used the directional sort of method, right? So then, okay, cool. Now, what would I expect? I expect this projection, okay, again, this is in a 2D space, right? Again, the data is 3D, but I'm projecting it into 2D. I do expect now the clustering to sort of sit on a sort of spherical surface, right? Where it is spherical on a unit circle. 2D, it must sit on a unit circle, in 3D on the sphere. But again, I'm having the issue where these clusters are not consistently sitting on where I want it to be. So then this is a consequence of early transformations in the data where, you know, when I was standardizing the principal components, right? This is the lesson on not to over standardize your data because then you get effects like this, right? But nevertheless, the point is with 6 clusters, I had this issue. And then when I censored 2 of them, right, taking out those sort of like extremes, I'm still not getting this clean sort of projection onto the unit circle, right? Okay. So I had to change my approach a little bit. So what happened was, what I did was, I then decided, okay, let's go back to our 6 regimes. Let's look at, again, try to introduce some sort of degree of membership to say, okay, I know that this is not ideal yet, but I want there to be some sort of clear indication that there isn't any sort of switching or some sort of like membership where a regime is switching from one to the other and coming back. I wanted the sort of split to be a bit more clean. So I use now a degree of membership to say, let's follow a certain sort of cluster. And let's also then take into account that points from here can sort of wander off into a different regime but come back over time. So there's a bit of a, I would call it a fuzziness, a blurring in terms of the boundaries of the regimes. So I found that did help in terms of effectively getting the clusters more cleanly spread out. And eventually, right, I came to a point where I cleaned it up neatly with those sort of parameters. And then I've got something a bit more clean. So before I actually identify the regimes, I was able to cluster. I checked also in terms of these are clustered based on a directional sort of requirement. And then I looked at then these actual PCs in their sort of in their, how do I say, in the principal component values in the PC space. Make sure that those that aligned with strong, for example, strong labor, strong growth, strong inflation, I will cluster them effectively into expansion, etc., etc. So the whole point is to go from regime, right, clustering to regime identification. Okay. So just to recap here, from the regime clustering, right, I don't know yet what the regimes are. How do I then actually determine what they are? Right, like I said, what I'm going to do is for these points sitting in those clusters, then because I know what the PC values are, I'll then take the average of this. Basically, all the points sitting in this cluster, I take the average of the macro PC1s, right? And then essentially, based on these values, I can determine then, okay, what is a contraction, early contraction, expansion, early expansion. That helps me then label the regime. Okay. Once I've done that, I'm very comfortable with this. I then sort of can maybe simulate a regime path, right? So I know that it's not ideal because then you are fixing kind of this sort of behavior, right? I mean, so you're not allowing some sort of temporal evolution. You're kind of fixing the transition matrix and you're just essentially walking down some sort of next sequential path. But the whole point is, right, I was able to then simulate what sort of regime timeline I'm looking at. And then obviously with these regimes, right, I have a probability matrix, transition matrix, right? So that's the first step. Now I'm actually getting to a point of probability from regime. So it is regime identification. Now it's actual probability. So I'm getting somewhere. So from that clustering model, right, I wanted to test, okay, how well does it then actually identify a crisis or a contraction or some sort of deep like macroeconomic recession. So what I did was for the different principal components in regime, right, based on the clustering, I then considered, okay, how do I overlaid now those periods of when it was for instance, GFC for COVID. And then I just basically looked at the plot where to see, okay, the model, based on the way I labeled it and based on those macro values, those PC1 values, right? How well does it actually sort of beat up with well-established periods of, for instance, recession? So you can see here on the red dots, the contractionary points. So during the GFC, model correctly identified contraction. Right? For all 3 different components on growth, labor, inflation, as well as here in COVID, right? So I'm comfortable then that the labeling of the model is quite consistent. And as I said before, we need to get clean inputs in order to build our hidden Markov model, right? So this is the end result eventually, is that we've got some transition matrix. That transition matrix is going to be used as an input into basically into evolving that hidden Markov model over time. Okay. So some of the model like, okay, so we built now, we've got what we needed. Let's go back here to one more thing. In order to sort of build a hidden Markov model, right, we need to have some big assumptions, but also we need things to sort of like behave the way that's required, in a way that's required for it to actually go into the model to give us some useful results. For the HMM, right, a lot of the literature that said when you build sort of your regime time models using HMMs. You want the prior distributions, right? Those that basically give you those emissions that you see, the observables that you see. You want that prior distribution itself, those latent distributions to be normal, Gaussian, right? So when, so we know what the shape, etc., what we need, but clearly here you can see the densities of these different components in regime clearly don't look properly Gaussian, right? So over here it's got this long tail, it's very flat. So maybe it's too peaked. So we don't have clean, like clean, like sort of well-structured distributions for us to actually put into the hidden market model. So this becomes a problem now, because now the data itself is not clean or useful for us to actually build this thing. So I changed the approach. I said, okay, fine, because now I've clustered based on direction. I'm looking at this on a magnitude basis. I have to be consistent, right? I can't actually then suddenly go from a directional sort of clustering method to going something that's more magnitude aware again to build the model. So I changed kind of this requirement on the Gaussian so the emission distributions. I went back to my favorite friend here, similarity projection, right? Or similarity scores. I then use my emission matrix rather than it being a Gaussian matrix. I use a softmax, basically allows like a logistic type of regression. I'm using this directional dissimilarities in the distribution, and I'm getting out a probability. Yes, it is essentially it is a PDF in a sense, not true PDF, but it is almost enough for me to sort of use, right, in terms of its distributional characteristics, but I then kept the hidden Markov model construction consistent then with the same method I use for the clustering, right? Okay, so I'm still now working in that directional space and not focus on magnitude. I will use magnitude later on, right, for other reasons, but for now, I'm trying to be consistent. So my clustering is based on this cosine sort of method. I keep that same method for the construction of the hidden Markov model. And then how do I actually construct the hidden Markov model? I mean, these are the steps, right? You've got your forward backward pass, right? Which is essentially these two equations up here, or one, these two, right? But I'm not going to go through the detail, but the point is, right, from the emission matrix, right, we do the forward backward pass, we build out essentially a smooth posterior sort of distribution, right? And then we effectively have got now our posterior probabilities for the regime, right? Okay, that's now from the macro. So it's been a long journey here in terms of the clustering because we started off with just general PCs. And now we move from those principal components into the means of identifying the regime and also the probability of being in regime, right? In terms of the models, right, the diagnostics for the in-sample and out-of-sample, right, I am aware of the danger of overfitting, but we'll go through kind of what we got out of the diagnostics for the construction of the models. So in-sample, right, mapping accuracy, right, from the clustering method to the sort of hidden Markov model. So it's 0.871, so 87%, right? We have strong alignment, right, of essentially so what are we looking for? The evolution really, right, of cluster agreement, right, or yeah, cluster agreement, right. We have strong alignment with the clusters, right. In terms of the partitions, sort of, like I said before, we want our regimes to kind of not always be stuck because the boundaries. The problem we have is we don't want regimes to keep flipping from one to the other. We will allow, for instance, the data, right, or in regime to kind of float to a different regime for a period of time before coming back. That's that degree of membership. But then, we want the partitions still to be quite clearly sort of labeled, not labeled, but like, what's the word? Clearly identified, right? You want to be able to see that this information belongs to that cluster, right? So we've got strong sort of consistency on that side. On the in-sample side. On the out-of-sample, very difficult to kind of measure out-of-sample. I mean, the accuracy numbers look too high, right? But that's, again, there's no real ground truth for this. But nevertheless, the point is in terms of the state detection, it is pretty strong, right? Again, we're looking at the confusion matrix and then the overall sort of F1 scores, it has sort of balanced performance across the states. And in terms of this posterior sharpness, this is the part where it can get a bit tricky, right? Depending on that transition matrix inputs that at the beginning, right? You want there to be some stickiness in regime, right? But not too much such that it gets stuck and stays in that regime, right? So you don't want there to be sort of these sharp boundaries from one regime to the other, right? You want it to kind of move around and come back. So you want kind of this walk around in terms of your transitions. The sharpness is still too high for me, right? Kind of tells me then if I'm going to use this to project out a sample, I'm going to be kind of stuck with this problem where I'm going to be essentially maybe just in one regime for a long time before it actually switches. So it becomes a bit of an issue, but again, right, I'm still working on ways to improve that. But for now, I'm comfortable that I'm getting good sort of fits to the data. And in terms of the state detection, which is more important, right, it is quite robust. Okay, so far so good, right? All right, that's now on the macro. Go back to the market. All right, so now on the market side, right, it's a little bit more, I think, easier to explain this one because essentially using the yield curve, we've got our features. We're going to do a bit of feature engineering on this. So we're going to use the level, the slope, the curvature. We're going to do some sort of transformations on these features themselves. As I said before, for the volatility, we've got 3 different inputs. Eventually, we're going to use a PC1 for this to get one sort of latent driving force. And the persistence, I mean, okay, that's a bit of a challenge one because there we have a lot of Z scoring on trying to I understand momentum across the curve because with the persistence, we don't want the slope to change too much. We want to be able to see, do we have some sort of momentum effect in terms of the structural shape of the curve, right? So we feature engineer, right? And then from here, we build our classifier, right? And then we've got the logistic regression, right? And then now we train the model, right? So what are we actually training the model on? We want the model to effectively, right, predict, right, curve shape changes. So based on the curve, based on what the market has done, how the curve has reacted, we're not focused on regime yet. We're just looking at the curve itself. We know this behavior, like a bear flattener, for instance, the short end rates tend to increase more than your long end. Bull flattening, long end rates regressively tend to fall a lot more than your short end. So we know how to label that behavior, right? And what we're doing is we are training the model such that we're able to predict these shape changes, right? Now remember those shape changes I said at the beginning, those shape changes are in response to perhaps market regime changes, right? So we need to get from this level very effectively from a curve sort of shape change response to effectively identifying a regime, right? So that's a tricky part, right? So now we've built the logit model, which can help us probabilistically identify how the curve would sort of change based on those features, right? How did we build it? We said we use a logistic regression, right? Yeah. Here's our last function. So here essentially is the logit part. I mean, this is our classifier. This is the probability we're going to get, right? Sorry, classification 1 or 0. This is the probability out of it. Here's our penalty function, right? So we also need to penalize. So I want to try to avoid overfitting. As the literature would suggest as well, I mean, there's a mixture here between 2 forms of penalty. You guys be familiar with like L2 and L1. So the mix between Nassau and Ridge sort of penalty. We call this method elastic net, right? So there's a mix between the two. Okay, long story short though, right? We fit the model, right? Get the probabilities of these shape changes. Now, how do we actually get from the shape change to the regime? We go back to the hidden Markov model. We use information from the hidden Markov model in terms of in-sample, in terms of how the macro sort of evolved. You then use that effectively to learn from, right, how to map then the curve shape change to the regime, right? So we use information from in-sample, right, to get a sort of I'll call it basically this matrix S, this learning matrix that allows us to essentially move from your curve shape change into your regime. Then it's detailed over there. Okay. Anyway, so we're going to compare 2 things now. We're happy that we've got the posterior probabilities for the macro. Check. The market, right? We calculated them now, right? Using the logistic classifier, right? Trained to identify these shape changes then using the in-sample sort of macro regime identification, using that information, then map essentially your curve response to regime, and then update our market probability from that aspect, right? So I've got one over here, right, which is essentially shape change, E, that's learned, gives me a new posterior market probability in regime. And then what I've also done is I compared that to the theoretical mapping. So as I said earlier, right, usually in a specific economic regime, if you're moving, for instance, if you're in a contraction, what do you actually expect the yield curve to do? As I said before, in a contraction, you have low growth, it's disinflationary, you've got low labor. What you typically would find is that the curve would first bear steepen before it bull flattens. So one long-term persistent behavior is the curve will bull flatten. In a expanding economy, one that's sort of like late expansion, moving towards like an overheating stage, the curve typically would bear flatten, and you get the idea, right? So the point is, there's a theoretical mapping, right, to get from curve shape to regime. And then what I've also used is the actual sort of market behavior on the market. I use the macro to infer regime, and then try to map the market behavior to that regime, right, to get I call it more like that the model learned from the existing information as opposed to imposing a theoretical sort of mapping. Okay. Cool. Hello. Come on in now. So, and now this is now basically what we've been working towards, right? Once we've got the posterior probabilities for the macro and the posterior probabilities for the market, right? One can effectively calculate this metric, which is called total variation, right? Which is essentially going to measure this divergence, right? So if you think about it in regime, if you identify the same regime, what does the macro posterior probability say? What does the market posterior probability say in regime? And then you look at the difference. And for each of those 4 different regimes, you calculate that difference. And then you sum it up, and then you multiply it by half, right? This is just to kind of average it out in a way. But this is basically the L1 norm. But the point here is you get this measure of divergence, right? Lower is better. So if it's a 0, it means that the market and the macro is perfectly aligned. And obviously, you know, if it's not that, you've got a bit of this slide, right? So now let's get some of the results for you. So the first graph measures the divergence, right? So the outer sample period, so I'm doing this now outer sample. I built the models with in-sample information. So I'm basically using this over 2019 to 2025. Again, I've tried to sort of label the graphs with specific macro sort of events that happened in the US. The first graph here is the theoretical mapping, which is basically all over the place. It basically says that well, the market doesn't really sort of work in the way the textbook would say it does. And the second one, right, is essentially the one where the market implied probabilities, right, the regimes that were sort of identified there learned from the macro, right? So in terms of what's on the graph, right, the blue line itself is the actual divergence measure. The orange line is it's just a moving average I use to kind of give you an idea of like the shape itself, right? Just to smoothen it out a bit, so that you can clearly see this is a lot more, I'd say, informative than this. This is quite noisy, right? So we're using the learned mapping, right, from the macro, right? Let's try to understand some of the divergences that we do observe. So this is the part where I was actually trying to reconcile, is it true inefficiency, or is it got to do with really like the forward-looking nature of the yield curve and the risk premium, right? But nevertheless, you can see there's some sort of average value, right, around this 0.2 level, right? In 2020, when there was COVID, so basically COVID-19, you can see there was divergence between the macro and the market, right? In 2022, essentially this was the time when the Fed were hiking interest rates, right? So the build-up towards that was a lot of uncertainty. But then as the Fed started to hike the market, then again, the divergence closed, right? In 2023, this is kind of the peak inflation. The Fed were actually responding to that. And then the fourth part now with disinflation, not really much happening here, stuff in the market and the macro generally consistent. So again, I mean, I'm trying to read a lot of information out of that, right? Kind of things stick here, but it's kind of the first step of actually measuring some sort of misalignment between your macro and market. Right. So I'm kind of ripping these up, but in terms of contribution, right? I've tried to introduce this idea of the divergence to bridge the macro regime inference and local pricing. And also understanding, right, this idea of understanding macro risks, which, you know, that's constant divergence of 0.2, right? So the Excel means that and still get to identify what it means, right? Again, I'm trying to reconcile that between, you know, is the market's behavior just in terms of its forward-looking nature, and also, you know, how does it, in terms of time during premium, is that what was repriced in there, right? On the regime switching side, I spent a lot of time doing all those models to cluster. I may put a headway there, but I think the way I've introduced the more directional aspect of clustering versus way research by the research that I have found, all kind of are making the same mistakes I did initially by using sort of those utility-based type of clustering approaches. I think mine is a bit different. This consistent with some more frequent research, but the way I've built the HMM with that softmax sort of emission distribution, keeping two kind of how I constructed the clusters, right? That's something that I haven't seen in the literature, so something that new, something that I've done. And then, yeah, as I said, portfolio application, right? In terms of the PMs, right? You could use things like in the macro market divergence to help us with timing strategies and to be more regime aware in our certification. In terms of validity, right? I mean, again, like I said, I'm using the macro sort of information, and I've got interpretable local features, right? So nothing black box. Basically, everything is observable, right? I tried as much to also validate against, you know, the MB cycles. I use some of that for purposes, and yeah, I mean, logic testing just to ensure that macroeconomic theory and market experience that we are consistent. Whatever sort of any sort of theoretical explanation for what's happening in the macro, we can actually pick up from the markets and vice versa. And of course, if there is a divergence, that's where we can pick it up in terms of those two not being consistent with each other. From a rotation point of view, okay, so there's a lot of work, right, for just essentially focusing on the US. What I plan to do over time is to do cross-country application, right? So I haven't tested this like in commercial market context. I would ideally love to actually test this on the UK market, given the fact that there've been a lot more events on the macro side, as well as, I'd say, you know, post-Brexit, GS, Brexit, COVID, and the like. There's a lot more sort of, I would say, periods where I think, you know, we can pick up population, basically the divergence, right? I think it's limited, you know, from 20 to 2000 to 2025, ideal up to come back, but then the data itself is difficult to get hold of given what I need, but also, you know, the cleaning of data takes a bit of time. So that's kind of also one problem to create limited short. Sampling frequency is nothing, and that I think is a bit of a problem because ideally what you want to see regimes change over time, you want to see sort of a transition. This is going to kind of force a bit of noise. But the other issue is I don't want to create too much lag in the model because remember the yield goes off, we're looking at trying to be a little bit more closer to when the data is released to the market's reaction, right? So again, it's still a limitation. And as I said, you know, earlier, predictive success of the measure itself, right? It could be explaining efficiency, it could be explaining this time during risk premium. I'm yet to identify what that is. As I said, with the divergence, we've got this baseline of 0.2 on average, but again, I just see a sort of effect based on really fact that it's only from the Alzheimer's from 2019 to 2025. Okay, and in terms of direction of the research, like I said, cross-market extensions, something that I love to do. As PM, right, this idea of actually using it in the sort of in the real-time context, right? I mean, it'd be lovely to sort of get a better way of updating the macro, right? A lot quicker than having to wait for sort of data releases. And we could use Bayesian methods to do that. You could use the divergence also to understand central banks and the market divergence in practice if there's any sort of differences there. I spoke about the trading, and then finally, I think the whole point also is to kind of get to a point where we could use the divergence actually to predict excess market returns. That would be very useful. But again, I think the biggest sort of question for me is trying to tackle whether we are looking at risk premium, time value risk premium and efficiency, and can be used in the divergence range to explain either or both of those. I think, yeah, conclusion wise, as I said, I think the biggest thing for me, in the work that I do, and also in sort of adding to some of the diagnostics that we don't have in our sort of tool set of fixed income, hopefully this measurement can help us, provide a further diagnostic contribution. Thank you, guys.
Good. Questions? Mohammed? Why six things?
Okay, so 6 because I wanted to capture. Okay, so firstly four because actually I'll go back. We'll start from the beginning. Early studies on regime switching, right? Essentially looked at two sort of possibilities. You either expanding or you contracting. But then in that expansion contraction, right, you can either stage where there's potentially an early contraction or an early expansion. So there's a bit of, before you go into full expansion, there's a bit of a, I'd say like a waiting time and then you want. Why 6 is because it takes those 4 into account, plus then you got extremes. The extremes being a full-on crisis, and then another extreme being on like when there's a pure economic boom on these super weeks. But then you could argue that this is why I reduced it, is because having 6 regimes made more justice, but then the problem I had was so basically you can't, when you start to switch from one regime to the other, right? The model couldn't tell the difference now whether it was in a contraction versus a crisis or an expansion versus a boom. So then I just collapsed those two into them basically in contraction and then into expansion, right? And then I found then further on the class tree and even the regime sort of timeline started to make a bit more sense, because then you weren't stuck in like getting confused between here or here, because you kept moving between the two. So like the PCs are also quite tightly bunched into one area. But like I said, when you look at the directions now between, say, a boom and an expansion, they are literally in the same direction. So it didn't make sense to then go and separate, because you're getting sensing.
We have a question. If not, the left hand one. Got it?
It's, hello everyone, my topic today is offering insurance problem with small transaction costs. It's a part of my PhD thesis, still, but it's not going to be like, this one's coming from paper in which we are going to work. It's an outline. First of all, we start by introducing, giving the power. And building framework. When you see dynamic programming method, which is the introduction used to derive our issue. I'm going to talk about the rule of free method, then the conclusion. So, in order to understand what I'm going to do, I just find out it's going to be interesting to give you a brief introduction on continuous time portfolio problem, because the idea on which we are building our world. So I'll take you to that, and then from there, continue with the rule of free. So studying a continuous time portfolio problem tends to be the life of my recommendation among different factors that people have. Let's also be maximized the investments of education by managing risk, then to develop dynamic investment strategies. It's also account for issues fashion. So the idea of continuous time portfolio selection was first introduced in the article portfolio selection and transaction costs by constructions and margin. So what they did in their paper, just their work was based on portfolio selection and transaction costs. That's in one dimension. And the second one is a paper from Peter Stoddard, Steven, and Ricardo. They developed several economies in articulation, especially with the sun. So the paper along which we are holding our following the paper on choice. So what we are basically going to do is to try to set up our financial market. So we consider the financial market with no risky asset, S0, and actually it's T risky asset. So if we time with the price process. So so this is the evolution of the price of sigma house. This is where that view is sigma. Sigma status is very sigma. So these are the conditions in which for which is dynamic system. So we talk about XT, the value invested in riskless assets, and by YT, the value invested in the risky asset at any time T. So the state variables X and Y are controlled by the choice of LIG, which is the concept from from asset I to asset J, method up to time T, and vice versa. So LIJ considered as non-decreasing in the adaptive process in the following condition. then L0 is equal to 0, then five times. So in addition to intelligent activity, the agent shows that friends are combined by one the loss of the in CT using the rates of consumption tends to be more passive. So such a pair CL is called a consumption. Well, that will follow the states. TXT and following that in TXT and so TXT is the value of hence and this quantum is the chain of the investor position as an I induced by just A. And epsilon to the power of 3 times lump is our proportional. So here, epsilon is making as small as possible. So defining the value function depends on the transaction cost as the slope over the expectation of this one that you see. So using dynamic programming equation, solving transformation behind that this programming equation. This quantity is you cheat that on this one. So you can see this one as a double mean. First one doesn't depend on IQ, but the second one depends on IQ. So I can put this one inside here. And then my second mean is going to be as outside the one that doesn't depend on IQ. So I define my L like this, just with this much simple, and partial limits. So using in order for us to really be rigorous on the solution of this kind of equation, this mixture problem, we need to apply the homogenization technique on this solution. So we are not going to make any assumption on the regularity of G. So what we are going to do is to try to create a fast variable, which is psi I. So that fast variable is defined as the following: the deviation of the investor position from the optimal investment strategy, which is the one board. So Y board is the optimal investment strategy. So I didn't put it here because I know it's not really box. But you get this quantity by minimization of, let me go back to the situation there. If you see clearly here, it's the little problem on the value function which gains to transaction cost. So whenever epsilon goes to 0, which is, you can take this for whenever epsilon goes to 0, you end up with the value function, the method value function. So you can take the method value function, meaning that epsilon goes to 0, and then apply the dynamic method to derive the dynamic programming equation. So once we get the dynamic programming equation, and just try to isolate the solution. So the solution that minimize the equation in the frictionless case. I mean by frictionless case, like whenever we are not dealing with transaction costs. If we are not dealing with transaction costs, our epsilon ends to 0. So the maximizer in this one are Y and C. So Y is called the Merton investment. Optimal, the Merton optimal investment. So it's the deviation. My investor is here, but the position of my investor is here. Then the deviation from that scale by epsilon. And then we use an answer like there is no solution for such. So such a problem, there is no analytical solution. So we want to numerically fix this solution. So we use an answer of my value function would depend on the transaction cost, which is the following. It's such that W is 0 is equal to 0. And then applying use this answer, and if you use this answer and you plug in here with some transformation, you get those productor equations. So the first one is the following, and the second one is the following. So here A is a unique solution such that the solution of the first productor equation is. So basically what we are doing to solve this kind of problem, we start by setting this part with the one that ends equal to E. And then solution that we get from that one is OD. And then from that, we kind of distribution algorithm to derive that I will explain. So before moving to the policy iteration algorithm, you have to see that this first productor equation can be interpreted as a mergodic control problem, which the work was done by Fabian Campillo in 1996. So it was for us to apply the policy iteration algorithm on this one, we need to see, instead of saying this one as a discounted problem, you need to see, you rearrange if you want our problem as the undiscounted case, in which case we use the long-term average. The long-term average over integrals. So, and then I'm going to talk about the numerical parts. So here we define our Fibonacci matrix like this. So applying the policy iteration on this first productor equation is going to give us two steps. So the first step is going to be, which we use the Fibonacci difference is going to be the first equation, which help us to get that omega. And if you are very familiar with policy iteration algorithm, there's two steps. There is one that we call policy evaluation, which help us to get that omega. And then omega and A. And then the minimization part or the maximization part, which is here, try to find the control that relies on maximizing the local density. So when you do it until a certain range is expected to this confidence. So if you do it correctly, you will get this kind of shape. So I'm going to explain quickly. There's a top left, there's a top right, there's a middle left, there's a middle right, there's a bottom left, and then there's a bottom equation. So before moving to comment on the simulation, this one is what we call, is the one that defines the first one here. So let me use my head. the first one here is the one that defines the no trade duration. So the no trade duration is the one in white here. Whenever you see white, this is what we call the no trade duration. And then the one here is the one that defines the trade durations. So the other count dot the white about trade duration. So whenever you are inside the white box, you are not allowed to trade. Oh, but if you are outside the white one, you have to trade. So let me comment the first one. So if I use those parameters, those are the risk aversion and the discounted factor and then the productivity, but I assume that there is no correlation between the assets. Reason why it's 0, and then I use my transaction cost. Okay, there is something that I have to precise. Here, the transaction, the trading, there is no trading between the risky assets. So, because if you do have trading between risky assets, the shape here is going to change a little bit. But in our case, we consider that there is no trading between risky assets. The trading is between the risky asset and the safe asset. Okay. So, and then if I take my wealth equal to this quantity, I will end up in this first shape that you see. So, if I'm here, as I say, because there are no trade ratios, I don't do anything. I don't sell, I don't buy. If I'm here, I sell Y2. So there's something that you can understand on those axes. So psi 1, if you remember correctly, is the deviation of the investor position from the method investment, method optimal investment strategy. So because we divided by the wealth here, so this value is normally what you see here is that minus 7.50 times 10 to the power of 3. But because it's divided by the wealth, this one can be expressed as a percentage. So it's between minus 0.15 to 0.15 on the x-axis, and then minus 0.15 to 0.15 on the y-axis. But why are we doing that? Why are we dividing? Because whenever you do the numerical simulation, you have to take your set in which you define, in which you do your discrimination has to be big. So I mean by big now, and the value that you take. If you take the interval A and B has to be big. So if you use this value that you see here, you don't see the desired effect. Whenever you simulate, you feel like there is a kind of divergence. You don't see the desired. So that's how we scale by Z. When you scale by Z, you can see the desired effect. Okay, so if I'm in the yellow parts, I have to sell, right? If I'm here, what I'm going to do is to just think of which fraction of wealth do I need to rebalance my portfolio. So if I'm here for me to rebalance, because the idea is to avoid transaction costs as much as possible. Because whenever there is a transaction cost, I don't want to transact a lot because there is a cost whenever I trade. So if I'm here, for me to get back to this position, because that's the rebalancing one, I want to get back to these positions in any position that I have, which is not inside this one. So if I'm here, I have to. This is Y2, but you have to sell, not to buy Y2. So I'm going that direction to the right box. If I'm here, if I'm in that direction, because this one is asset 1 and this one is asset 2. So I'm buying asset 1 and then buying asset 1, and then I'm buying asset 2. So think of direction. Whenever you are in the same direction, you buy. Whenever you are opposite the direction, you sell. So in the corner, for me to rebalance, I don't need to buy only one or to trade only one asset. I have to trade on to two, above asset one and asset two. So that's the idea. And then there's one comment that I want to make. Whenever there is a negative correlation between asset one and asset two, which is here, because my rho is minus 0.1, I have this shape. Here is the rectangle. Whenever there is no correlation. And if you see the area of the rectangle, they keep on increasing from this one, this one, this one, this one. I mean the area of space that is taking. So why? Because the volatility keep on increasing. So whenever the volatility increases, the shape of the growth region increases. And if there is a positive correlation between the assets, I do have a parallelogram, but it's shifting from the left. If my correlation between the assets is negative, I do have a parallelogram that is shifting from the right. So with this idea, we talk about, okay, because we read similar papers, then we realize that all the work that people did was in 2 dimensions. So we just asked ourselves, is it possible to do the same things, I mean the same analysis in dimension number, maybe say more than 20. So we did the same simulation to see, when we realized that the policy simulation algorithm is computationally very expensive to do that, because remember, I said before, we have to discretize this one. Is the trace. So if you discretize, you use finance difference to discretize this one, for you to get the value of omega, you end up with a linear equation, meaning that you have to deal with the inverse of the matrix. Right? So if you deal with the inverse of the matrix, there's a because of dimensionality as you increase the number of assets. So you fail to do that because it's computationally expensive, and then the inverse of the matrix is difficult to read. So then we ask ourselves, is there a possibility of doing the same thing, but using another method to simulate those things in dimension t greater than 20? Then the answer to this one is yes. So it's yes, because think of if I have one asset, no, sorry, I have one investor, one agent in one dimension, like I'm dealing with one safe account and one risky account. And the only way for me to trade, I'm exposed to only 3 ways: buying, selling, or holding. This is if I'm dealing with one asset. If I'm dealing with 2, I will have 3 to the power of 2 possibility, right? If I'm dealing with 3 assets, I will have 3 to the power of 3 possibility. So if I'm dealing with 4 assets, I will have 3 to the power of 4. So as the number increase, my set of actions increase exponentially. So the reason why you cannot use the policy of creation to do that. So your space of action increase exponentially. If your space of action increases exponentially, meaning that you need to look for another method called the deep deterministic policy region. So this method is going to help us to develop the method. So you can think of 2 neural network that we are going to use. Sorry. You can think of 2 neural networks that we are going to use. The first one is called the actor, and the second one is called the preaching. So the first one, if you are really familiar with reinforcement learning, then you are looking for the optimal action. So the first neural network is the one that estimates the policy. By estimation of the policy, like the best action that you can. And then the second one, we want that to be value different. So we found out that there is a paper by Alex and R, which which is right of optimization. This one is an interesting paper because actually there's only two papers where people when they are trying to use cheap this in the model free sense. And I want to mention something. When I'm talking about model free, I'm talking about modeling by learning from data. When I'm talking about model based, I'm talking about modeling. It's an equation, like it's model based. The first one that we saw is a model based one. So if I say model free, you either learn from data or from simulated parts. Okay? I mean, you can think of taking a S&P 500 and then try to learn from that, or simulate something, process, execution process, and then you have to do. So, it's in the work, but you do the simulated part. And this work, they consider the transaction cost. So, and our work is based on this idea, where they use simulated sample part. It's still going well, so I'm going to give you just a brief idea of it. Now, as I said, the act of pitch framework models large space and action space. Then this is I'm just trying for distribution, and then the target network stabilize is the training process. And in the TDPG, you have the experience rate, which removes the duration between the sample and uses the user. So, as I said, there is only two papers, to the best of my knowledge, on where people try to use trading transaction costs in the model. What we are going to do is to try to think of, if you remember, when I define the value function, there's an utility function inside. So most of the literature on transaction costs, especially the first one from Orwell, didn't include the reward function, didn't include the idea of the utility. It just used an S&P 500 and then try to operate the transaction cost, then proceed with the analysis. But if we want a model that can mimic what we have seen, we have already seen, we need to think of the utility in our reward function. So reason why you see here there is, all of this here is a quadratic function. Because this one is a one norm and this one is a two norm. So we have, if I want to extend this one, we are going to have pi t plus 1 to the power of 2 in the in the first direction, and then pi t plus 1 to the power of 2. You move the second direction because you have to think of pi t plus 1 as a vector. That's why I'm using 1. And then AT you have to think of as a vector. You know that 18 is equal to 18 in the direction 1 and 18 in the direction 2. So then it's subject to this one. Then the sum is over on it. So you consider that our PT follows the Markovian dynamic, but in our case, it's going to follow the OU process. So the first one here is the first step, and it's the one that models the transaction cost from change in coefficient. And the second one is the risk return, and it acts as a regularizer, analyzing this key portfolio. Now, as I said, this one is expressed like this, according to the direction. So, moving from the first equation to this one is really simple because, sorry, we are looking for a proportional cost. So we just have to multiply that by this point, and then since we are saying that we say that this risk act as a regularizer. So we just have to multiply by the value lambda. And then subject to those two. You can see that because this one is the vector, so according to the direction, and the analogy is going to be. And then so the next phase is going to think of how to solve this kind of problem. Normally, according to the literature, there is no solution. I will answer the solution. Even though you want to solve, you cannot. So they use in a certain paper, I forgot the name of the author. They use a technique to solve this kind of thing. So you just have to consider the term inside as a function, which is here. If you just remember how you just see, you are just matching term as minus. So given that my explanation is going to be the number, and then from there, divides over pi t. So before getting to the solution, remember I said AT is a vector. So if this one is in one node, it means I'll have absolute value of AT first direction plus absolute value of AT the second direction. And then AT is the difference between pi t and pi t minus 1. So that's why my function depends on pi t. And someone can ask, why did you and this one as well is the same thing. Like if you extend this one, you're going to have the sum of pi t to the power of 2. And then just differentiate and then with some optimization technique, you get the solution. So this is an approximate solution, because there's no actual solution for this. So what we are going to do is to now build a reinforcement learning agent that will learn this function, which is going to learn this functional strategies, and then confirm if it learns well or here the only thing that we are looking for in this approximation is the value of psi. How do you call this one in English? Psi. And there's another thing that I can see. I don't see another why. Oh, and lambda. So psi and lambda. So you are going to determine this one using this section. And then once you have your I'll make some comment quickly. This solution is what we call it's behaving as a bend. If you want, like, you have your axis and then you have your bend like this. So whenever you are inside, you don't read. Inside means between those two. Then if I'm outside here, right? If I'm here, I see. So that's the next. So now we are still working on the reinforcement learning agent and to see what will happen and see if our DVG is going to work well on it. And for the future direction, we are going to explore other environments because the first one that we are dealing with now is the environment is dealing with the proportional cost and quantitative cost. So there is another environment. So the main idea is to try to get a control problem for which there is no solution. And then from that, build a reinforcement agent that can make what's happening in the node solution. So it's still an ongoing work. So thank you for your comment and question in case that you have.
Yeah. Any questions? Comments?
So I think I missed the portion, on the second model, I mean, the second approach.
Mhm.
So what is the transaction? So what is your main goal? Just, I mean, like, is it minimizing your, how much you spend on transaction? And how did it appear in the last, I mean, if you go back to this. So where to represent your cost? Yeah. I mean, like your transaction.
What's the question?
Where to represent your transaction in this,
Transaction cost.
yes.
Is the gamma.
Okay.
That's it. It's gamma. No, gamma. Oh, no, it does not appear because whenever you do the differentiation, it does cancel. Okay, very good. Yes.
Okay.
Yes. Because I said AT is equal to pi t minus pi t minus pi. And then that differential by pi t.
Okay.
So because we did pi t minus 1 because we know already pi t minus 1.
Okay.
So there's going to be a constant because the now is going to match all of them. So if I expand this one quickly, I'm going to and I have something quickly so maybe we can talk about it to expand it because as I'm looking at it like this, I cannot really, but I need something to write. So,
Okay.
but it's going to cost us a lot.
No, less than that. Just come back here. Okay. Yes. Okay, hope you have a great lunch. So our next speaker is and we put up and talk to us about an optimal investment and consumption model, transaction costs, and reduce switching. Yes, very project. How about you?
Thank you. As mentioned, my name is Professor Ramkhale from the University of Limpopo. I'm doing my first year master's under the supervision of Professor F.J. Mhlanga and Dr. Ngosi. So the project that I will be presenting to you is titled An Optimal Investment and Consumption Model with Transaction Cost and Regime Switching, a stochastic differential utility approach. So before I can start or proceed, so I want you to keep this scenario in your mind. Imagine you're an investor who has a wealth or who wants to allocate their wealth between the risky asset and the safe bank account. But during or before you can allocate your assets or before you can buy or sell an asset, you have to pay some fees. And during that term of your investment, there's also the changes within the market. And in this scenario, your aim is to find or like is to your aim in this portfolio or in this scenario is to maximize or find a strategy that will satisfy your investment. So this is the outline that I've prepared for this talk. I'll be starting from the introduction and background throughout the references. So I'll take you through as I proceed. So we know that the real world or markets include the frictions such as the transaction costs, which refers to the expenses that are incurred by the investor when they try to buy or sell an asset. And this friction plays a huge role within the market. So what happened is that the classical method or models didn't include these frictions for a very long time because of the complexities that are associated with this friction. And also another thing is that the market also has the periods where the prices can go up for a very sustainable period of time, such as the bull market, and also the periods where the prices may go down, so such as the bear markets. And these changes or fluctuations that happen within the market can subsequently affect the returns, volatility, and also the risk that is involved within the market. So what we are going to do is that we want to reflect the real world or the actual investors' behavior. So our model will focus on those frictions and capturing them into one framework, of which I believe has never been done before. Actually, it has never been done before under this conditions or when the utilities of the stochastic differential form. So as I already mentioned, this mathematical theory of portfolio optimization, it's not a new thing because it was also done by the likes of Robert Merton in the late 60s, extending into the early 70s, where they assumed for a very long time the market was frictionless, basically trying to avoid those complexities that were involved in the market, or in order to solve those things, equations. So this has been done for a very long time. It's a very broad or widely studied topic within the field of financial mathematics. So I've included some literatures in order to substantiate for what I mean about how this topic is widely studied. So such the likes of Kraft and others in 2013, they assumed or they used the recursive utility in incomplete markets, and Gassiat and others They also studied the optimal strategies under the illiquidity. So, but the study that actually caught my attention was the one in 2024 done by Herigen and others, where they introduced the aspect of Epstein-Zinn stochastic differential utility, which is basically the tool that allows us to separate the risk aversion parameter and the intertemporal substitution. So unlike the above mentioned studies, what I'm going to do is I'll be considering those frictions in one model together with the EZSDU. So for the preliminaries, we formulate our model. This is the usual. We formulate our model on a filtered probability space, which will satisfy those usual conditions and also model the flow of information that is available to the investor over the time, which is the finite time. And then we are also going to consider our regime market, which is driven by the Markov chain with a finite state space, where in our market we have at least 2 states or regimes. And then we will define the regime process that is associated with the generator matrix that basically quantifies how the market changes between the states or captures the market changes between the states. And then in our case, there's 2 assets which is trying to allocate their wealth to. So the assets are maybe the risk-free asset or the fund, and the risky asset, or you can also know their best stocks. So we model our risk-free asset, which is denoted by S to the power 0 and T, using this equation number 1 with the regime dependent interest rate, meaning that the interest rate in this case can remain constant for some time, but may change between the states. So there are a number of risky assets which are involved within our market, and then they evolve according to equation number 4, which is the usual geometric Brownian motion with the regime dependent drift and the volatility trend, and also the Brownian motion, which introduces the uncertainties within our market, and it's also adapted to the fluctuation FT. So our investor initially has the wealth XT, which is denoted by XT there, and also our investor wants to allocate their assets to different their wealth to different assets. So the amount that is invested or that is allocated to the wealth to the risky asset is denoted by 5T, and the remaining proportion is denoted by 1 minus this summation is invested in the risk-free asset. So under the assumptions that the investor during this investment period, the consume the amount for the sum of the investments, and the portfolio is also self-financing, we can now then denote our wealth process using equation number 3, where we have this CT, which we use to denote our consumption rate during the investment period. But this is a classical problem because it is frictionless. It doesn't accommodate our issue here. So in order to accommodate our issue, we introduce the aspect of transaction cost. So we denote our transaction cost using the proportional transaction cost using this lambda, of which is always or has to always be greater than 0. When we are trying to adjust the risk asset allocation, so we can then now remodel or redefine our wealth process, which will then include the transaction cost. So it's our wealth process with the transaction cost, where this LC and UC are non-decreasing processes which represent the cumulative buying and selling of the risky asset. So and this control here, this control is of finite variation, meaning that it captures the difference the differences in prices between the transaction cost that is associated with the buying of the asset and also the selling of the asset. So in order for us to make sure that the new or proposed wealth process is sustainable and well defined, we define some admissibility strategies, taking into consideration those variables that are associated with the wealth process. So basically these conditions here, they just ensure that we do not run our account does not have zero balance. So basically, make sure our balance is our portfolio is always secure. So, in the investors' goal during this period is to actually maximize their expected from both the consumption rate and the terminal value, where in our case, we are going to use the EZSPU in order to reflect the real preference model. So meaning that we are going to separate their risk aversion from their intertemporal substitution. So now we can then remodel or formulate our optimal portfolio problem as equation number. Is equation number 5, where we have the Epstein-Museum recursive utility process, which is subject to the wealth dynamics that I've already mentioned, and also those frictions. And how do we, and then now considering that is an SPU, we can then define the stochastic differential utility, which satisfies this backward stochastic differential equation number 6, where we have the EZ or the Epstein-Museum aggregator, of which will help us separate those variables that I've mentioned, which is the intertemporal substitution and also the risk averse, where we have the terminal condition, which is denoted by that expression, the last expression. So moving forward, then the investor's problem, taking into consideration that terminal condition and also the not the terminal condition, also the EZSBU, we can then now write this equation, which is number 8, and then which is subject to the singular control wealth process, which includes those the transitional. So we define some value function of which we will use, and then using that value function, we then define our initial wealth and equate it to X, and also the regime process, equate it to I in order for us to be able to change or switch the regimes, and then this will be associated with the new boundary condition, which is denoted by that expression, where we have the epsilon. So the theorem that we have here is that for the frictionless case, our transaction cost is equal to 0, of which is not what we are looking for. So in our case, we are more focused on this case where the transaction cost is involved or is taken into account. But so that our problem now can become a quasi-variational inequality in the form of equation number 12. And then our goal here is to maximize that QVI equation number 12. So what we are going to do is to consider the candidate value function for the frictionless case, and we also use the answer. So we propose this value function of which we are going to use to derive the first derivatives, which we are going to substitute to our frictionless case, and then find the first order conditions of which we are going to use. Okay, so firstly, let's focus on the consumption, first order conditions. So solving that, we get this optimal consumption rate and also consumption strategy, not rate. And also what we are looking for basically is this one, the second one, which is the investment. So the optimal investment strategy is the one that we are going to use as a benchmark for our, as a benchmark to measure the weight of the risk asset so that we can be able to accommodate the no trade region. So what basically we are doing, we are going to use that frictionless solution or the optimal investment control, and then we are going to measure the weight of the risky asset, meaning that we are going to look for or this thing here is this diagram here is basically a simple, but it plays a huge role in our case. So you may take the look, I mean, look at this as a thermostat, because for example, if for example a thermostat, if a thermostat you it seems like it's normal, but when the temperature gets too high or when it gets too low, that's when you decide to act. Like if the price is, or if the price moves from this side, you make sure that you buy so that the price can be balanced, so that your portfolio doesn't your portfolio doesn't go bankrupt. So in conclusion, we have developed a comprehensive portfolio optimization framework which integrates the proportional transaction cost and the things switching under the retail SKU. And also we have derived closed form solution for the optimal consumption and investment. The transaction cost also becomes a singular control program which requires a QVI with the optimal strategies involving a no-trade region. So for future research directions, we are going to prove we are going to prove the existence and uniqueness of our solutions to the regime switching QVI with singular control, and end up incorporating the additional realistic features like taxes, borrowing constraint, and partial information. So this is the list of references that I've used, and I thank you.
Any questions? Comment?
Very minor one. Look, this looks very, very interesting. But I just say in terms of future directions, please do not just run a simulation study. I think it's, I mean, also what we've learned during this conference, I think practitioners, or like if this ever is going to be applied, or if you're interested in having, I think you need to show how it performs in a real world setting. I mean, that's of course much more difficult than doing simulation, but I think it's worth it. Very interesting model. I mean, you have a lot of features in there. So I think you should definitely try, if you have the time during your PhD, to apply to a real world setting. It will be easy to get that out and test it.
Any other comment? No, let's thank which email? Oh, not yet.
I haven't seen him.
Oh.
Silent man.